Hello and welcome to the complete scalp trading course by Wealthy Education. In this video, you'll learn profitable technical analysis setups and proven price action strategies for scalp trading. You'll learn how to perform a multiple time frame analysis, how to identify market trends and directions, how to trade with chart patterns and candlesticks, and risk management strategies for scalp trading. And as always with Wealthy Education, you'll learn with real world examples. So sign up, come on in, let's get started.
Hello and welcome to the Complete Scalp Trading Course Module 1 Scalp Trading Foundation by Wealthy Education. In this video, I'll talk about scalp trading and exactly what it is. In front of you, you have a weekly chart of the SPY. This is the ETF that tracks the S&P 500. And this would be considered to be a longer-term chart. Each candlestick represents a week, so it goes all the way back over the course of a couple of years, and you can even zoom out and look back to 2009, 2003, whatever. So scalping, on the other hand, is more along the lines of trading on short-term charts. So you may be more interested in 5 minutes. Now, 5-minute charts tend to offer more opportunities. It certainly offers a lot more in the way of volatility, but one of the downsides of scalping is the fact that the market, you're trading in the noise. So, and I'll get to this in a couple videos, you want to trade with multiple time frame analysis. You don't just go in and go, hey, this looks like a great place to start selling, and do it. Now, there is also what is known as swing trading, and swing trading is something that you see more or less. You're trying to catch the bigger moves, but not necessarily, it's not always going to be the long-term moves. Like, this is a 4-hour chart. You might be in it a couple of days. Longer-term trader, you're obviously trying to hang on to big, huge moves. And then there is day trading. Now, day trading means that you enter and you exit a trade within the time frame of a single day. So this would be where maybe you get up in the morning, you decide to short the SPY, and you get out later in the day. Scalping, you might actually do multiple trades during the day. You may be talking about just picking up a few ticks here and there along the way. A scalp might be, for example, and this is a little foreshadowing, but say we're right here in this area, and you notice that the market finds a lot of push and pull right here, and we break out of it, and you may just try to get to the next area. Little, short, quick, rapid gains. It's about being out of the market most of the time and trying to capitalize on it. Scalping can be very profitable, but scalping can also be very noisy if you are not cautious, and therefore somewhat dangerous. That's what we'll get into in this course, how to become a successful scalp trader. Scalps, again, very quick. This is a 3-minute chart, for example. Each candlestick is only 3 minutes. So this entire move is basically somewhere along the lines of about an hour. So that gives you an idea of the time frames you're dealing with. You see this area here. There seems to be buyers right here. We break through it. You scalp it for a couple points, and you get out. We'll talk about money management. We'll talk about psychology, performing multiple time frame analysis to kind of put you on the right side of the market, because you are dealing in micro movements and they can be somewhat noisy. That being said, before we really travel down the road of learning how to scalp, we'll have to talk about terminology, and that is our next video. Hello and welcome back to the Complete Scalp Trading course by Wealthy Education. In this video, we'll talk about scalp trading terminology. Now, in full disclosure, these are terms that are used in most types of trading, but you need to know them regardless. There are some terms that will come up time and time again that you need to pay attention to. There's an uptrend. Now, that is when price is rising, considered to be a bull market, sometimes you will call it. There is a downtrend when prices are falling. considered to be a bear market. There is sideways or consolidation. It's kind of the same thing. It just means we're consolidating in an area. There is continuation. So, for example, we have rallied here. We have gone in an uptrend. We have a bull market, at least on the 1 minute chart. We've consolidated a bit and then seen continuation. So, uptrend, consolidation, continuation. There is a bid and an ask. So, the bid right now at this point is $452.56 in the SPYs, and the ask is 456 or 452.58. So what this means is, if you wish to buy it, you have to pay what the sellers are willing to sell it at. If you wish to sell it, then that's what the buyers are willing to do. And in the middle, you'll see the spread. In this case, it's 3 cents. It does fluctuate depending on where people are willing to trade. But these are all things that you need to know. So the bid, the ask, the spread. Going long means buying something. Going short means selling it. There is such thing as a gap up or a gap down. Gaps occur mainly on the daily chart, so it's not really a scalp thing, but it is something to be aware of. So for example, we gapped lower, and then we turned around and gapped higher. Well, when you gap higher like this, especially with volume, that typically means that there's a lot of interest in the market. The size of the gap matters. This is a much more powerful story than perhaps this tiny little gap. So you can see that the market certainly was bullish. And when you see something like that, you may look to buy it by scalping it along the way, upwards for that day. There is what is known as a swing high and a swing low, and that's going to be the same on any time frame. So for example, that's your swing high, that's your swing low, that's your swing high, that's your swing low. You can see that markets rise, they fall, they rise again. So these swing highs and swing lows are worth paying attention to. So for example, this is a swing high. Well, once you break above that, that's a very bullish or uptrend type of signal. It shows that the buyers have gained new ground. You also have terms like breakout. So, for example, if you consolidate, like in this area here, you can come over to the paintbrush and check out the rectangle. Notice that we're consolidating in this area and then we broke out of it. That's all breakout means, is that you have left a consolidation area. You can average up, meaning buying as we go higher, or average down, buying as we go lower. Averaging down, trying to buy a market, is a great way to blow up your account. So you should never do that. There are some people who suggested in terms of a retirement account, but that's different. You know, you're not scalping anything. You're not even looking to swing trade it. You're looking to hang on to it for decades. So you're getting it at a cheaper price. Any smaller time frame than that, it's a path to ruins. So it's certainly something that you should not be looking to. Each candlestick or day has a high and a low, which is pretty self-explanatory. The highest price reached, the lowest price reached. The close, which is where we close during the day, and the open, which is where we opened during that day, or in this case, it's a week, but it all means the same thing. It's per time period. You could even say, like in a 15-minute chart, there's a high, a low, open, and close. There's also the 52-week high or low. That's just the yearly high or low. So, for example, this is being recorded in 2022, so there's your high for the year. So far, that's your low, but it's not a 52-week, so you actually need to go back 52 candles to find it. It just shows that there's momentum to the upside or the down. A lot of this is really just basic terminology. I'll use this during the course, so watch the video one more time. but it's not vital knowledge right away. You will get used to all of these terms as we go through the next several videos. And in the next video, we'll talk about performing multiple time frame analysis. Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, we'll talk about performing multiple time frame analysis. So, as you can see, I have Bitcoin in front of you, and I have it for the weekly time frame. And I will switch to a line chart for now, just to show you what has been going on. So, I think it's safe to say that we have been in a longer term uptrend based upon the week. And you could say the same on the day, although we have been a bit choppy. So this is vital information. Let's go ahead and try something else. Let's try US Steel. You can see the daily here has been very bullish, rallying, and we have rallied on the weekly. You can see that we had fallen. We'd been in a downtrend for quite some time, but we are starting to turn the corner. By looking at this, you can see that the weekly and the daily are showing signs of strength. That's your longer term trend. That means you should be thinking about buying. You can look to the 1 hour and the 4 hour charts. So this is your 4 hour chart. It looks very bullish. There's your 1 hour chart. It looks very strong. And at this point, you have all of your arrows pointing higher with your weekly, daily, 4 hour, and 1 hour charts. So when you drop down to, say, the 15-minute chart, you recognize that every time we pull back, if you are buying, you are moving with the overall trend. Same thing here on the 5-minute chart. Notice that we rallied most of the day, leading here the 29th, the 30th, the 31st, and even the 1st. Now, the new day did see some selling, but notice how it recovered late in the day, and that's quite common. You'll see that longer-term traders come in and they pick it up. So that's why, as a general rule, you only want to trade with the trend. It doesn't mean you can't make money in the other direction. It just means that trading with the trend will save you a lot of headaches. So let's go ahead and take a look at dollar Swiss. Let's move this to the 1 week chart. You can see we're chopping along begrudgingly. No clear, obvious trend, although you can say that we are rallying. So once we start to turn around, you recognize that, hey, since last year, every time we rally a little further to the upside. You look to the 4 hour chart, it looks like we have bounced a bit here. You look to the 1 hour chart, we are starting to curl higher. And then you go to the 15-minute chart and you can see if you can make a trade to the upside. Keeping all of this in the back of your head is a great way to make sure that you're on the right side of the market. Now, there's no way to completely guarantee that every trade's going to work out. But when you work with the overall momentum of the market, you find yourself more often than not on the right side of the trade. So even if you're going to scalp here the dollar yen, this is obviously a strong market. You do not want to short. Scalping can be done on the 5-minute chart. It can be done on the 3-minute chart, the 1-minute chart, whatever you choose. But you look at the higher time frames and you say, okay, what's going on in the bigger context? So it should not be a surprise that we broke above here and then rallied, 4 or 5 pips since then. Now, this is late in the day on Friday, so there's not a lot of momentum. But you can see that it jives well with the market in general. This keeps you out of so much trouble because, unfortunately, if you don't look at this chart, and you only look at this chart, and then maybe even this chart, you may think, well, hey, we're in a downtrend. And while that might be true for the last several hours, odds still favor a move to the upside. And in fact, you quite often get more than you bargained for with the trend. If you're only thinking 3 or 4 or 5 ticks or pips, you may end up with 12 in the blink of an eye. You just don't know. So we will focus on trading with the longer term trend throughout the course. We'll ingrain that in you, and it will be something that'll be second nature. And then next video, we'll touch on trading psychology, which is a huge, huge key to success. Hello and welcome back to the complete scalp trading course by Wealthy Education. So this is a video that I cannot show you on charts. This is about trading psychology, and in and of itself is a complete study. However, I would impart to you that trading psychology is a huge, huge influence on not only the markets, but your results. So take a look at this PayPal chart, and it's a daily time frame, but it really wouldn't matter. What does this tell you? This tells you that there is a certain amount of fear holding this. Look how we have completely capitulated and fallen apart. Just as the move up to this was greed. Well, that shows up in your trading as well. You need to have a plan ahead of time because, unfortunately, when you get in the heat of the moment, it's too easy to have greed or fear take over. So let's take a look. Let's just say the 1 minute chart. You short this market, you decide to sell it, you're trying to profit on lower moves, and then it starts to work against you. Well, you have a fear of taking a trade against you, a loss, if you will, and you get out. Or worse yet, you don't get out. And in that scenario, the losses compile. On the other hand, if you get a bit too greedy, just like you would have in this situation, perhaps, let's just say that you have a signal here and you recognize this is an area that will be interesting for buyers, and you're supposed to take profit there. Well, if that's your target, that's your target. You leave it alone. You do not try to swing for the fences, as it were. Your risk might be this much and your target might be that much. And that's perfectly doable. If you know that going in, then that helps you overcome your fear and greed. You know when it's time to get out, you know when it's time to take profit. There is such thing as overtrading, and this is especially true in scalping. With scalping a market, in theory, you could be in and out all the time. The reality, though, is you need to find areas that matter. So I would mark this up as, there's an area that matters. There's an area that matters somewhere right around there. All of this stuff in the middle doesn't. And unfortunately, people want to get in and out of the market as much as possible. That greed kicks in and you feel like you need to trade. And overtrading can lead to consecutive losses. I mean, you will have consecutive losses sooner or later anyway. That's just part of the game. But if you have consecutive losses, you shouldn't feel rushed to get it all back. You should recognize that your system, your trading setup that you look for, is or is not there, and that's it. Your risk appetite, your risk management plan is what it is. So if you're risking 0.1% or a full percent, it doesn't really matter. What you're risking is what you're risking. You don't risk anymore. You don't say, hey, I've shorted this market. I shorted it all the way down here because it broke out, but now it's going against me. But, eventually it's going to come back my way. You don't behave like that, especially scalping. Scalping is very difficult in the sense that you have to be able to take losses quickly. Kill the monster while it's small. So you have to have rules ahead of time. Let's say 3 consecutive losses. You just quit trading for the day. You're just not in sync with the market. And that will happen, especially if you're scalping, because you're talking very small movement. There are a lot of ways to improve your trading psychology. I would urge you to study, buy books, that type of thing. But you also need to paper trade. You need to trade a demo account so that you learn how a market behaves, and you learn that, sometimes things just happen and there's no way around it, and that's fine because in the long run, you know that you'll make money. Psychology is without a doubt one of the more difficult parts of trading because there is so much emotion with winning and losing when it comes to finance. Think about all the trouble finance causes for people in the real world. So trading, of course, is going to be no different. So with that, I would also suggest that you should journal at the end of every day, see how you traded, notice things. Maybe there is a certain pattern in your psychology that tends to work against you or for you. You need to be aware of all of this. It's a real study in introspection, but it's very important. And in fact, some would say it's the most important thing. It's easy to look at a chart here and go, well, I would have just held all the way through here. Well, the question is, would you have really? Do you have the stomach to hang on to a move as it comes back against you? And then here, are you like, oh my God, this is the end of the run. I better keep all of these gains. Those are the questions that you need to address, and they can only be taken out with experience. And that's why demo trading or even trade simulators, there are plenty of trade simulators out there that you can use and give you a bit of a heads up on this. In the next video, we'll talk about risk management, which in a sense is part of psychology in the sense that it keeps your risk relatively low, and therefore your psychology should kind of come along with it. Hello, and welcome back to the Complete Scalp Trading course by Wealthy Education. In this video, we'll talk about risk management for scalping. And to be honest, this is risk management for most trading. That it really doesn't change much, just the numbers. So, for example, if you're swing trading or trend trading, maybe you are thinking in units of weeks or hundreds of points, as opposed to scalp. It might be 1 point, 2 point, 3 point, that type of thing. The chart I have in front of you should look familiar. It's PayPal. We were just on it. This is a 5-minute chart. And there are a lot of different things that you need to keep in the back of your mind if you choose to take a trade. Very first one is risk and reward. So, how much are you willing to risk and what is your expected return? Minimum. You should be looking for a $2 return for every dollar risk, or 2 unit for every 1 unit risk. So if your target is, let's just say you're shorting this and your target is 20 cents, your stop can't be any more than 10. And the reason this is important is because you are trading in a very noisy environment as a scalper, so you have to be diligent. This allows you to be, let's put it this way. If you are, just say 10 and 10 cents and 10 cents, risk and reward. 50% win and loss ratio really isn't break even because there are some spread cost involved or whatever, but it's close enough. So if you have 5 trades at 2 to 1, and let's just say you make the first one, you miss the next one, so you're down 1 plus 2. You miss another one, you're down 1. So now you're down 1 unit, $1, and you make this one, you're up 1. So that means you only have to be right about 40% of the time in a 5 trade situation. Now, over the course of time, if you get good, you're hoping to get at least 40%. And really at this point, I'd even argue that 1 to 3 is even better with scalping. Because in that scenario, if you get a 40% hit rate, now you're talking it's plus 3 total. Those are all wiped out by the extension. These wipe that out, but now the $3 or 3 cents or whatever wipes that out. So that's the first thing that you need to pay attention. Stop placements. Typically, stop placements are going to be where momentum has shifted against you. So if you sold here, you recognize that there's been a lot of sellers in that area. If we break above there, something's changed. Pretty straightforward. Signs of momentum loss. So let's go ahead and switch markets here. Let's go to the euro dollar. we've been rallying here, and then we get a big red candle, a big negative move during that 5-minute period. After this bounce, you're kind of in a downtrend. That's actually an entry signal to sell, just as you may have shorted there, and then you see that we get 2 or 3 green candles. It might be time to take your profit. Again, with scalping, you're better off having a set stop loss and a set target and just let it do its thing. Volume analysis can come into play as well. You need a market that has volume. So, for example, Bitcoin. The volume in Forex is actually just based upon the server that you're trading. It's called tick volume. It's not really the same thing as the amount of trades. But notice here's a trade where we had bounced from there. We had a lot of momentum and a lot of volume come in. And it looks to me like the buyers are starting to take over, and that's exactly what happened. You put your stop loss on the other side, and you go from there. There are what is known as support and resistance levels. That's essentially what I've been talking about this whole time. The market's been supported there. Buyers come in. If you break down below there, the market's telling you something that it wants to go lower. There's also something known as Fibonacci. We'll get into this later, but they are levels that traders look for based upon mathematics. This thing pulled back right around 50%, and we went higher. That's kind of something that people look for as well. Really, at this point, the most important thing is to pay attention to swing high and swing lows on short-term charts. Make sure that, make the market break through everybody else's orders before they take yours out. Also, if you're looking at recent history, we broke through all of this, and this is an area that we had seen a lot of buying at, so that makes a nice target. And see how you could have put your stop loss right there, and that's like a 3-to-1 target. So it is possible. You just have to think the things out before pressing the buy or sell button. We'll go through all of this again later in the course, but I just wanted to give you a fundamental understanding of what I will be talking about. That concludes Module 1, the Scalp Trading Foundation. Now we'll start to get into the more of the meat of the program in Module 2, Profitable Scalp Trading Strategies. Hello and welcome back to the complete Scalp Trading course by Wealthy Education. In this video, we'll begin Module 2, Profitable Scalp Trading Strategies. This video looks at understanding support and resistance. This is, without a doubt, the most important part of technical analysis. Support and resistance can be thought of, quite frankly, as where markets are supporting price and where they are resisting going. So this would be your support and this would be your resistance. In other words, people are willing to step in and push higher here, just as sellers are willing to come in and push lower, or at the very least, buyers are not as aggressive here. So as I've drawn this here in the pound yen with these two lines, this is basically like 163 and 190. And you would say that there is support at 163 yen, there's resistance at 190. Pretty straightforward. And you can see this by looking at charts over a longer period of time. It's a little easier to notice than short term, but we will take a look at both. You can click on this line tool over here, and you want the horizontal line. And what you're looking for is an area that seems to have a lot of buyers at, like right here. But notice something. Over here, there's a lot of sellers. Notice that we have sliced through it a couple of times. It doesn't, it's not like the wall of death. It's not that you can't go through it. It's just that traders are attracted to it. I would also point out that a lot of times big round figures tend to attract a lot of attention. So you can right click, put on settings. In this case, I would just put 150. this is a weekly chart. Like I said, we'll get to shorter term. But this is an area you think would capture a lot of attention. And clearly buyers have come in and probably down to about 149 yen. And that's not that uncommon for there to be more or less a zone where people are willing to step in and pick up, in this case, the British pound against the yen. If you draw these lines at big round figures, a lot of times you'll start to notice a pattern. So in this case, since we're on a weekly time frame, you can see 140 has seen buyers come in several times. It even offered a little bit of resistance, so it's been support and resistance. So, why is it important to know these things? Well, it is more or less a guideline to where the market may react. Doesn't mean it doesn't have to. But notice market memory. There were a lot of sellers there. We got up there and pulled back right away this past week on the chart. Is it, knowing that there were a lot of sellers there, is it a huge surprise to think that somebody might be selling once we get back there? Well, of course not, because those orders are still there. So that's the idea. You're looking for places to look for buying or selling opportunities. And in fact, you're going to be hard pressed to find a technical, meaning like a chart-based system that isn't going to be based around support and resistance. That's almost always your first step. Another thing that I would perhaps suggest is that one of my favorite visual aids for support and resistance is that of a high rise. This is the first floor, this is the second floor, third floor, and so on. Well, if you're on the first floor, there's an area of resistance. That's your ceiling. That's where the sellers are pushing. But if you jump up to the second floor, this ceiling now becomes your floor. If you jump up to the third floor, that ceiling now becomes your floor. If you drop back down to the second floor, this floor is now your ceiling. And the reason is order flow. There's buyers and sellers there. So for example, there may have been people watching all of this, and when it came back at this point, they bought because they realized, hey, there's a lot of buyers there. There may have also been people who had sold this down here thinking that there was going to be a big breakout, and now that they're close to break even, they're willing to buy the position back at either a small loss or break even. That's the thing about trading. It's all psychology. So let's take a look at, say, the 15-minute chart. I'll go ahead and put a support line on. You can see that there had been buyers there. Notice that we had tried to break through here multiple times and sold off. So you click on this line and you can drag it by the bubble and you kind of see what you come up with. Well, obviously there's something going on there. Looks to be more or less a zone. So what you're looking at is where the buyers and sellers have come in. And these are, you think of this as a roadmap. So what I suspect is there's an entire area of selling up there, and that's why we can't break out. That being said, you don't simply take a trade based upon just because it's there. Some people do, but then you look for price action or an indicator or something. So the way to think of it is, so let's just say we're trading Ethereum. So a way to look at it would be, let me go ahead and add that volume on again. Okay. So the way to think about it is you want to maximize your possibilities and you want to recognize where markets may or may not be willing to go. Notice that we pulled back from there, and notice later when we came back towards that area again, we bounced again. So if you had this line there, from previous action, you know that once we break out and we come back, there should be some people interested in buying down there. And there is a candlestick here. Go ahead and hide the volume for a second. That could technically be thought of as a buying signal. Either way, it's an area where you start to look for a trade. There's a pattern here that bounced from there. You can see that there's clearly some resistance there, at least in this area here, and we broke out from there. So what you're looking for is you're looking for a place to get involved in the trade where buyers and sellers are. It's probably the simplest way to put it. Let's go ahead and pull up a stock here. Let's go Boeing. Now, you should probably do top-down analysis if you're going to do support and resistance. Because it's one thing for there to be support on the 15-minute chart. It's an entirely different thing for there to be support or resistance on a daily chart or a weekly chart. You know, you can see that there were several times where we could not get above like 225 would be my guess. Well, that probably means a whole lot more than just a little area like that. And it's not to say that that can't be traded, but you can see there were bigger profits to be made. So again, all you're doing is you're looking for areas where the market flips, if you will, flips from one side to the other multiple times. Most of the time, it's going to be around a big figure. So in this case, your big figure is the 192 area. And again, like with all things technical analysis, if it appears like on a monthly chart, it's a lot more important than on a 5-minute chart. However, when you look at this and you see we finally broke through that is a sign that you could be a seller. And notice how we broke through it and we came back to retest it and then failed. That in and of itself can be a trading strategy. You get an area of consolidation. You break through support or resistance. In this case, support. You come back, you test it, you fail. That is a confirmation that you're breaking down. Same thing would apply to the upside. So you want to pay attention where the buyers and sellers are, because otherwise you're just kind of guessing. One way to think about this is more or less like signpost on a highway. We will certainly use this probably in every video between now and the end of this course, or close to it. And in the next video, I'll actually go through some trading examples that you may have used this for to profit on short-term charts. But by all means, if there's only one thing you do after all of this, I would highly encourage you to go, start out easy. Start out with the weekly charts. And, where have the buyers and sellers been? Where have the buyers and sellers been? You can see buyers and sellers there. And you notice how I'm way zoomed out. And then you go to the daily chart. And then you kind of mark that up. This is an area that seems to be a bit difficult to get through. And then by the time it's all said and done, you have multiple lines. Now, again, you put more faith in a weekly support or resistance level than you do a 5-minute. So that's why the best way to trade it is to look for like a weekly support level or a daily support level and then use the 5-minute chart at that point in time. You don't always get that opportunity, but the great thing is it applies in all markets, so it really doesn't matter. Okay, so again, the next video will be examples of scalping with support and resistance. Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, we'll take a look at some examples of scalping with support and resistance. So, you can see that I have the daily chart of Alibaba pulled up, and I will go ahead and mark this, what I would consider to be $110 level. And you can see over the course of really several months, it offered support. We broke through it. We've broken back above it. And now we're basically sitting there in real time. So the question is, how could you use this? Well, I think it's pretty easy to see how you could have used this area multiple times. So, for example, this is that same support level. It makes sense to buy it here. Well, why does it make sense to buy it here? Well, notice how we had bounced from there, and at that point, you really wouldn't know any reason in one way or the other. But notice that we bounced there again. So you had a trade set up there. It has already proved itself. And the first question that you will ask, obviously, is, well, what happens when it breaks through? Does it break through? Well, this is what stop losses are about. You put your stop loss, in this case, let's just say it's a 15-minute chart. You're not looking to swing for the fences. You see it turn around. You decide, okay, if it breaks down below 109.50, then I'm out. So this trade obviously worked out really well. And, you could have had a monster gain if you were willing to hang on for several days. But that, unfortunately, is not what scalping's about. And that is the downfall of scalping, is sometimes you miss out on these huge moves. However, you also have a nice opportunity if you are willing to look at longer time frames first. You see a couple of hesitation candlesticks there. We just kind of opened and closed at the same level. Then we got this massive move higher. Well, that could signify that we are going to go back to this area of short-term resistance, and we in fact did. So going back to what happens if we break through it. Well, remember, I told you what became support becomes resistance. We get a major breakdown. We fail there. We continue. Now we come up here to the same level. Notice this big green candle and then this negative candle after it. Well, what does that tell you? That tells you that the sellers have come back in and pushed it lower. Does that seem like a decent time to sell this? Well, yes, because the market is trying to tell you that it's selling off. You sell it at that point. Where do you think it can go? Maybe down to here. And that's exactly what happens. So you're risking somewhere in the neighborhood of $1 to make $2.50. So that's a 1 to 2.5 risk to reward ratio. It's perfect scalping opportunity. You don't have to make it any more complicated than that. And you really don't want to, quite frankly. We'll take a look at dollar Canada, and we'll go up to the daily time frame, and let's go ahead and see what the market's doing. Well, right now it's very range bound, but this is information that you can use. This is what is known as a hammer, and this is a candlestick that you will learn later. But what it does suggest is that we have tried to break down and then we've turned around. So notice all of that support. Look at all those wicks, and we couldn't break through it. So that day would have been very interesting. Let's go down to the 15-minute chart. Notice that we dipped down below there and just shot out of it like a cannon, just straight up in the air. Well, that's something worth noting. When you see price rejected so viciously, and I would also submit that, notice how it is basically 125, large round number. Or excuse me, not 125. It would be 124.50. So what is known as a mid-century number, still a big number. We shot straight up in the air, actually went to that 125 level and then pulled back. So when you see this bigger area, you begin to say, okay, well, how can I enter? Well, notice this offered support a couple of times here. So when we pulled back and started to squeeze along, you have a couple of different decisions you can make. Are you going to wait for it to continue to climb higher and put your stop just below this reversal? And if you are, where are you aiming for? Well, you're probably aiming for this 125 level again. Notice lots of choppy behavior and then it takes off. That is quite common in the currency markets. This is a market move here that could be thought of as an intraday trade as well. You know, there is no set, this is intraday and this is scalping. Scalping is generally a few ticks at a time, but the markets move at their own speed. So to get 25 pips and risk 10, again, 2.5 to 1. But just because the market hasn't given you all of your rewards in one shot does not necessarily mean you have to bail out on it too. Sometimes if your stop isn't hit or, something hasn't changed, it ends up, in this case, taking a few hours instead of a few minutes. So it's kind of borderline. I guess that would technically be an intraday trade. Although it was initially thought of as a scalp. And again, the currency markets are a little bit different. They do tend to move slower at times, so you do have to keep that in mind. So you can see Ripple. Notice how Ripple has found a lot of interest here at 85. Support. And you could have been buying this and getting rid of it 2 cents later because notice how 87 was support. Remember that support becomes resistance. So basically what we're doing is we're consolidating here. And once we break out, we know that means something, especially with volume. Notice the volume picking up. This thing spiked all the way down to 78 cents when it did break out. So when you look at this, you say, okay, well, we're hanging around 85 as support. We also know that it doesn't necessarily go to the exact, in this case, 4th decimal, 5th decimal. You can't say, okay, wow, it's 1/10,000th of a cent below there. It's time to start shorting. Just like here, you did peak out a little bit, but you never really broke the breakdown. So what you'll do a lot of times in this area, I like to take the horizontal ray and kind of see if I can figure out, okay, well, if this is a zone, and it almost always is a zone, where is that zone defined? And I defined it right around there. So instead of thinking of this as a specific line, you might want to think of it more like a box, a zone, if you will. And notice how clean it becomes. So once you break through there, all bets are off and you fall. Where can you go? Well, when you zoom out, notice that area there. And in this case, once you broke through this, you were there in 10 minutes. And that is basically 82 cents. So it's about 2 3/4 cents. And then Ripple, that's not a bad move. You have to keep that in mind as well. So that is using just sometimes volume and just lines. And there are entire systems drawn up about this. Another example that you could use, and I'll just use the 15-minute chart here. This is an area that has been resistance a couple times. And let's say, all right, you decided to buy on the breakout, pull back and retest. Notice how we go higher and we go higher again. This is an area that had been supported. This is an area that has been supported again after that. So once you're in this trade, you can move your stop loss up to here and let the market just drag you right along. So you've already locked in profit. At the very least, you're going to make like a cent, right? And you shoot higher here and you pull back and you bounce again. and then you put your stop loss right there at that pullback. You fall, you bounce again, you pull your stop loss up to there, and you finally get taken out. So you're dragging right along with support and resistance. Now, these are minor support and resistance areas, but they're worth paying attention to. Go back, review this video. Do not worry about it. I am going to go through support and resistance in almost every video, show you examples of it. This is something that will be pounded into your head time and time again between now and the end of the course. However, it's not just support and resistance you look for. That's where you start. You add other indicators as you go along. So in this case, it's a roadmap. And in the next video, we'll add something called the Bollinger Bands. On top, it'll give you yet another tool in your arsenal to trade the markets. Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, we'll talk about Bollinger Bands. So to put the Bollinger Bands on your charts, you need to click on this symbol here. Now, you can favorite particular indicators, and as I type in BOLLINGER, you can see Bollinger Bands. Now, there's a bunch of other ones as well, but you can see this is already favorited. You click on the star as you highlight it to have it as a favorite. Go ahead and click on that, and it will appear. And you can see that it is an overlay, meaning that it goes in an overlay of price. And a Bollinger Band is a representation of a bell curve, basically. If you remember from school that something like 96-ish% of all numbers in a set occur within 2 standard deviations. That's all this is. And it's using the 20 SMA as the median. So in other words, when price goes all the way up here, it has broken through the +2 standard deviations and -2 here. This is your median. So the idea, of course, is that if you get overbought, you should swing back towards the median, or if you get oversold, you should. That's really all you're looking at here. I know it looks a bit complicated, but it measures your volatility. So, for example, notice how thin it is here, but how wide it is here. Well, the reason being is price is moving. You can see how violently it's moving here, and it's broken out of these standard deviations a couple of times. Well, what does this mean? Well, this means that the market's overbought. So some traders will short and try to go back to here. Some will get really aggressive and try to go back to here. But the idea is basically you're looking to get back to normalcy. You can also see that it sometimes goes sideways. In this scenario, not as exciting, quite frankly. You can see that we have broken through here, and it took a while to get back to here. So you do have to use, some other things with this a lot of times, mainly support and resistance. Notice how we got oversold here, we went back. We got oversold here, we went back. So you're getting the idea that a return to the norm is generally favorable. And like I said, you can use the bands for consolidation trades, but quite frankly, most of the time you're better off just using plain support and resistance in forgoing the bands. The wider these bands are, the more likely you are to see violent swings. So you need to keep that in mind, perhaps when position sizing. So let's take a look at several examples. And there is something called a squeeze that you need to pay attention to. So notice how tight the market got. The idea is that we will break in one direction or another. And there are some people that's all they use Bollinger Bands for. When they get really tight like that, that's a sign that the market's about to move. because sooner or later momentum picks up, and you can see we surely did. Pulled back and then drove higher. Drifted lower, pulled back, drifted lower again. That compression is a sign that the market might be building up tension. So that's called a Bollinger Band squeeze. And traders sometimes will just use that, and then they'll have a target based upon support or resistance. Let's go ahead and look at the euro dollar. And on the 15-minute chart, you can see that we had gone sideways and all of a sudden pierced that and then did what they call walk the line. Walking the line means that you're just heading right along. So what happens is some people will use this because we did squeeze a bit there. They'll use that as an entry. And instead of looking to get back to the median, they'll put a stop loss there. And they'll just let it rock and roll until it takes the stop loss out, which is all the way up there. That's a 100 pip move. That's a big move. Now, as a scalper, are you going to do that? Probably not. But notice how here is a squeeze, and then we get a breakdown. We walk the line. So you could take a break of this support level here. Notice that it comes back here and short it again. Short it again. Your stop loss is easy. It's just on the other side of those candlesticks. So those are a couple of examples of how you might use it. Let's go ahead and take a look at JP Morgan. Squeeze, boom, huge move. Overdone, obviously. You expect to move back here. You get it. Nice squeeze, and then we grind higher. There does come a point where there's a little bit of artistry involved. You know, on a move like that, and we start falling right away, it's not uncommon to fill gaps. And that's exactly what we did. So when you get that insane of a move, it's not necessarily out of the norm to expect a return to the median. I'd also point out, notice where it stopped. It stopped right there. This is a 5-minute chart, so you can only read so much into 5-minute support and resistance, but notice how it was important back there as well. So that gives you an idea of how Bollinger Bands are used. Some people just use them for the trend. They're used in so many different ways. It's almost impossible to go through them all. But the main takeaway is volatility. How volatile are the markets? The wider it gets, the more volatile it is. The moving average in the middle. This is the average price of the last 20 candlesticks. It tells you the directionality of the market. Are we overdone? Are we oversold? That type of situation. And like I said, I will walk you through some examples in the next video with Bollinger Bands. This is one of those indicators that people either love it or hate it. So experiment with it, see how you feel about it. It's perfectly acceptable to use some or all of the indicators in this course. Bollinger Bands do tend to, for myself, I really like the squeeze because it tells you something's coming and to pay attention. So for example, take a look at this squeeze. Look how tiny it was. And then all of a sudden you got this big bar or big candlestick. So that tells you something's up, right? A little bit of resistance there, and then you got another one there and a huge gap. So if nothing else, I do like that aspect of Bollinger Bands. And in the next video, I'll give you several examples from which you can learn. Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, we'll take a look at some examples of using Bollinger Bands to profit on short time frames. So you can see I have NVIDIA 5-minute chart up. Notice how we've kind of been banging around for a while, and then over the course of, I'd say, an hour or so, we start to shrink the bands. Remember the squeeze? Well, we get a huge gap right here, and then go much higher. So one of the easiest ways to trade this would simply use the gap as the entry, and put the stop loss on the other side. So basically, the gap itself is your stop loss. You rally and you rally even further. Notice how there is an area of support and resistance right around 265. We bounced from there, kind of hung around there, pulled back from there, and now we got there. So once you clear that, then your stop loss goes just below it. And you are already in profit. You have locked in about $3 in profit. As you pull back and then you rally again, you put your stop loss there and you keep going. Notice how, and you would expect this with a big move like this, a huge volume spike. So that's another thing that would get you into the trade. There's always something called a double bottom as well, which we'll talk about later. We've walked up the line, so really at this point you could just dynamically move your stop right along with this and you would have been probably taken out up there. Nice explosive move from the Bollinger Band squeeze. Another simple way to trade this would have just been to follow the trend. You can see that the trend is going higher for quite some time. Here's another squeeze down here. And you can see that we gapped higher. We came back, filled the gap. These gaps do tend to be supportive. Nice volume there, so you know a lot of traders got involved. Once you bounced above that median trade, or median line, 20 SMA, simple moving average, that's your entry. You put your stop loss on the other side of this candlestick. Where do we think we're going? Well, notice how price could not get above this area here at about 222, and that would have been a nice quick trade. So let's take a look in the Forex world. Let's do Australian dollar, Japanese yen. Now, this tends to be a very volatile pair, but notice how we really weren't going anywhere. And this is something that you need to pay attention to as well. Notice how the moving average is just kind of sideways. That tells you this is not a market that's ready to do much. However, you hide the Bollinger Bands for a minute, and you can see, you zoom out, and you can definitely see that there's some support in this area. You know, obviously, we've bounced from there several times. So let's go ahead and put that Bollinger back up. Notice how we break through there. The moving average is decidedly sloping decidedly lower. At this point, you could watch it walk the line. You put your stop loss on the other side of the moving average, and you get in about here. You get out about there pretty quick. You know, maybe 2 hours tops. That's a pretty quick trade. You know, again, it depends on the market. It depends on the time. This would have been the London Open, so that's when business is actually starting to open up. So this kind of formed during late Asian trading, which has very little in the way of momentum most of the time. Noticed how we had the squeeze and we had the takeoff again. Again, just use that other side of the line. And while this is, you know, this is beyond a scalp at this point, this is a couple hours, there's no reason to give up on profits if it's running in your direction. So that's why scalp, intraday trade, that they are somewhat interchangeable depending on the market and probably more specifically the market conditions. Let's take a look at Chiles. So this is a cryptocurrency. You can see we're going sideways. There's that walk the line type of thing. You just put your stop loss on the other side of that moving average. Happens there as well, although it's very noisy along the way. So you have to ask yourself, is there a clear trade? Well, I think at this point, with that oversold condition, once that bar closes, you can try to aim for this. Keep in mind, it is counter trend, so you definitely want to get in and out. but you would have been in and out of this one in about 30 minutes. Notice the resistance here 3 different times, right at about, 33 cents. So we bounce, bounce, and then pull back. So then you start to say, okay, well, where's the support? Well, the support is right here at about 31.5 cents. We break down, we retest that support. The moving average is dropping. So let's short there. Wait until we get a close outside of the range. You could take your profit really quick. Or you can hang on to it. It's entirely up to you. Let's go ahead and get rid of the support and resistance. There's another one of those squeezes, and you can see we just took off. Stop loss there. The squeeze is probably the most common way to use the Bollinger Band. But then again, like I said, some people will take this trade and they'll say, look at how far out of the range we are. Let's just go ahead and take our profit. And if you did that, somewhere in this area, you're in and out in about 10, 15 minutes. Because it's an overbought situation on the 5-minute chart. But you notice that there was more left on the table. In this particular case, we closed outside of the range there, but that's where the moving averages add. So if you followed the moving average, it's kind of 6 1/2, a dozen or the other. With that, I would say that you need to use a little bit of common sense. Markets can only go in one direction forever. Position sizing in these trades needs to be reasonable. You need to understand. So, for example, say you short this based upon it's starting to walk the line. Well, it's only going to take 1 cent, about a 2% move, and in crypto, that's not always a lot, to turn things around and take out your stop. So you have to understand that you don't necessarily want to put 10% of your account at risk in this scenario. Your risk to reward, you would look at this and you would say, okay, well, we're probably at least going down to here where the support is. So you also need to keep that in mind. You may tighten your stops just on the other side of the moving average. Whatever you do, make sure you're at least trying to get $2 for every $1 you're risking. As long as you stick to that plan, mathematically speaking, most traders do fairly well. In the next video, we'll talk about moving averages, exponential moving average. This is a simple moving average. It's just the average price over the last 20 candlesticks. Very similar, kind of give you an idea how this works. Again, Bollinger Bands, not for everybody, but they are a helpful tool to give you an idea what's going on under the hood as far as volatility is concerned. Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, we'll take a look at how to use exponential moving averages. So the first thing that you need to understand is that it's an overlay indicator. So that means it's up here with price. A moving average is just simply the average of price plotted along the way and then connected, so it becomes a line. So for example, if you're using 20, then what you'll get is the average price of the last 20 candlesticks, regardless of time frame. So it could be daily, hourly, 15-minute, doesn't matter. It'll plot it, and then it'll connect it in a line. And the idea is it tells you what the trend is, whether there's momentum, that type of thing. Average price means something to a lot of traders. Exponent, and that's called a simple moving average, an SMA. Exponential moving average is just, it's basically the same thing, but it puts more weight on the last several candlesticks in order to make it a little bit more sensitive. So I'll show you an example of both here, and you'll see what I mean. How it's different, whether it's extraordinarily different, that remains to be seen. I think it comes down to the time frame you're trading more than anything else. So this is the moving average, and you can see that there are different inputs here, and I'm going to change this. Let's just make it 50. You can see SMA, so that's simple moving average. So that's literally the average price over the last 50 candlesticks, and you can see that the line, in an uptrend it's rising, in a downtrend it's falling, etc. So let's go ahead and put the exponential moving average on the chart. And I'm going to click on the settings here, and let's make this 50. I'll make it red so that you can see it a little bit more clearly. And the input, I'm going to make it exponential moving average. And notice, it basically tells you the same thing. It does move a little quicker than the smooth does. So it becomes more important on shorter time frames because, quite frankly, I don't know that this would change your trading much on a daily chart, but on a 5-minute chart, it most certainly will. So the idea is it tells you the trend. You can also make an argument for dynamic support and resistance. So let's go ahead and put this back up. There are a couple of major moving averages that people pay attention to. There's the 200-day EMA. That shows you the overall longer-term trend. So the idea is this is your baseline. If you're trading Jacobs Engineering, even if you're scalping, you don't want to fight the trend. So price was above this level all the way from July 27th, July 30th, 2020. Didn't really break down below it until December 20th, 21, and then January 13th, 22. So that entire time, if you're trading with the trend, and you really should be, you're looking to buy only. So why 200 days? Well, there's roughly 200 days of trading on Wall Street per year. So that's all that means. Let's go ahead and take a look at this one. This will be 50. Why 50? Because 50 represents a quarter. So first quarter, second quarter, third quarter of the year, etc. There is such thing as a golden cross and a death cross on the daily. These are only on the daily charts, but they are considered to be trend changes. When the quicker EMA, the 50-day EMA, breaks above the 200-day EMA, that signifies that you're going in an uptrend. That signifies that you're going into a downtrend, but now we're turning back around. And therein lies the problem. While this is a signal to go long, quite often you get a little bit of whippiness. So you don't want to just see. Once upon a time, traders used to just buy here and then they would exit there. And obviously, this would have been a very strong return. That being said, this entire time here, for like 7 months, it's been dead money, and then you finally got knocked out. You're gaining, you're losing, gaining, losing, gaining, losing. It would have been simpler to just take your profit based upon price action, which you'll be learning in this course. But these are terms, and then the death cross is a downtrend. These are terms that you'll hear pop up from time to time, so you do need to be aware of them. Now, the idea is, like the 50-day EMA has offered dynamic support. You can see the buyers continue to come in. It does break down. Again, in this scenario, you want to have like real true support and resistance come into the picture. So like where it broke down below here, you can see it found support at a previous resistance level. So you'll want other signals just simply besides the moving average to get involved. So let's go ahead and switch them, the moving averages to, and again, let's make this red just so you can see it. Let's make it 9 and 20. These are a little bit more doable for short-term trades. So let's drop down. We already know we've been in an uptrend, been sideways. Now we're in an uptrend again. Let's drop down to the 15-minute chart. And the idea is you cross upward momentum starting to work in your favor. That works out. You could have shorted that. Again, though, you don't really want to fight the longer term trend. Look at this area here. That's where we bounced. You would expect that kind of thing. Let's go ahead and move to JD.com. So, kind of the same thing here. Nice explosive gap higher. You can see that the moving average is the shorter time frame. The 9 has crossed the 20 and is spreading out. That's a sign of growing strength, just as this is a sign of growing weakness. In theory, you could have shorted this, got back in here. You know, that the only problem with trading like that, and a lot of people do, is that you have to be very cognizant of when the moving averages are going sideways, because you'll get chopped up and down. So you have to be very cautious. Let's change this to, let's change it to an arrow here. 15-minute chart. You can see that both of these tell you that the trend is moving in this direction. Notice how it chops back and forth. So how do we overcome that? Well, you look for simple support and resistance. Right here is obvious support and resistance. On a pullback to that and a break above that, it shows you that we're resuming the uptrend. Excuse me, this is lumens, not Monero. You can see that we're in a downtrend. We go sideways, and then we start to spread out to the uptrend. That suggests it's time to go long. And let's go ahead and take a look at dollar Swiss. Nice crossover there. However, I would draw your attention to this. You know, you have to ask yourself, should I short it? Is the risk and reward worth it? It could have been in this case, because once it crossed underneath here, you could just put your support or your stop loss right past this short-term resistance, and that would be your target, and that would be a doable trade. Or you wait until it breaks down below there, and then retest and fail. So it bounced up and it failed. You put your stop loss above there as it starts to drop, and you, in theory, could have hung on to the trade until you got across, which would be all the way down here. Not really a scalp trade. It is a longer-term trade, but from here to here, that support, that resistance, nice, like 4-to-1 risk to reward ratio. Again, you know, this is just yet another tool. It's not really something that you need to be held to, in the sense that I think a lot of traders look at this and they say, well, you know, the X moving average is right here, so it can't break through. That's not true at all. And you can see even times when it holds, it does pierce that. So it's a guide, nothing more, nothing less. Again, you have to look to your support and resistance, and then eventually you'll start to learn candlestick formations in this course and things like that. But this shows you that these are entryways, or at least possible entryways. In the next video, I'll go through several examples of scalping with the EMAs, kind of show you how it's done. Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, I'll run through some examples on how to use exponential moving averages to scalp the markets. In front of you, I have the dollar yen, and the first thing that I would say about this is notice these moving averages really aren't going anywhere. So when you get a situation like that, one thing that you can do is you can draw a rectangle of the general area that you're in. So you know what you're up against as far as consolidation. Now, notice that we do break out of it right here. But also notice that that's where the last, on this move down, that's where we bounced and then fell. So one would anticipate like 122.40, 4.45 offering resistance. And that's exactly what happened. So you're scalping the market based upon breaking out of this rectangle, you're putting your stop loss at the bottom of this big candle here. You're entering at a break of it, and you go to that level. Pretty straightforward, pretty easy to see. Pretty quick profits, really. That was like 15, 20 minutes. So notice here, support, obvious support, but I would also point out, and is what is known as a triangle, and we'll go into greater depth later in the course, but you can see that as we hit this area here, 123.18, we bounce, but we don't bounce quite as high. We bounce again, but we don't bounce quite as high. So what does that tell you? Well, that tells you that the buyers are running out of momentum. So once we break through this, you have two choices. You can decide to sell it right there, and the moving averages are spread out, so you do have momentum. And if that's the case, you could put your stop loss at the top of this candlestick here and aim for the next cluster of support. And that's exactly where we ended up. Or you could wait for some type of pullback and failure, although the risk to reward isn't quite as strong as you can see. So let's look at let's look at Monero against the dollar. Now, this is not as liquid as the Forex market, so the first thing that you'll notice is there's a bunch of gapping and it's kind of choppy behavior. So you probably want to go to the 15-minute chart in this case. But again, notice you have nice consolidation at an area that had recently seen resistance. You get a nice candle breaking out of this area on strong volume, and the moving averages are spread out. So it's pretty much a straightforward shot. How far do you want to take it? That's entirely up to you, because there's no real guideline recently. But one thing that you could have done is just got out as they slumped. That's a nice little scalp here for, it looks to be about $2.50, $3. You're risking $1, so that's the right sizing as well. Keep in mind, it's very difficult to scalp the crypto markets from like the 5-minute chart. Like even Bitcoin's a bit tough on that one, and that's the biggest market by far. So let's take a look at US Steel. This market, let me zoom way out here. You can see could not break out above that area. Notice that the moving average is spread quite nicely. We've had a nice volume push here. You break above there, essentially $26. You give it a 50-cent stop loss here on this candlestick, and you just follow right along. You end up getting out here at, I'm going to call this 27.40. So it's $1.40. You're risking 50 cents. That's almost 3 to 1. And that's how this is done. You know, this comes down to stepping back and looking at the big picture. We've had a hell of a recovery here. So at this point, you know, it's more likely to either fail and fall, or it's going to break out. And it broke out. So this is another sign of support and resistance being a place to look for a trade, but you don't take it just because it's there. Once it's been broken, that means something. And you could, for that matter, keep this chart up, recognize that we're in the midst of something kind of important. We broke there to the downside, but we crossed here. Well, why does that matter? Well, it matters because we tested the $29 level a couple of times, and it was minor resistance on the way up. So when you get that cross, this big candle here gives you a little bit more confidence to perhaps aim for the most recent highs. Stop loss goes underneath here. You're risking about $1.50 here, but you end up with about a $3 gain. So it's 2 to 1. Actually, no, I take that back. It is 3 to 1. So you can see that this can be done, but a lot of it's waiting for the setup. Use that support and resistance as an area to look for potential setups, and then follow your moving averages or your Bollinger Bands or whatever you're using. Again, cannot emphasize enough how much support and resistance is your foundation. Think of it like a house. That's the basement of the house. Your moving averages, you're starting to build the subflooring. Price action, which will show a lot of that later, formations and candlesticks. Then you're really getting into the finesse part of trading. In the next video, I'll take a look at the MACD, or Moving Average Convergence Divergence Indicator. Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, we'll take a look at the MACD, or the Moving Average Convergence Divergence Indicator. So really, this is more along the lines of moving averages. Really not any different. So what you have here, I'll go ahead and open up the settings, and this is the default setting. That's what most people use. The fast, the quicker, remember we had 2 moving averages in the last video, is 12, and the slow is 26. And that's what's shown by these lines here. They're moving averages. You also have a histogram. So if you were to plot the 12 and the 26 on the chart up here, it would look exactly the same. But the histogram shows how far they are spread. In other words, how much momentum are we getting in one direction or the other? So as you can see, we crossed over here and then started to widen out. Notice the histogram gets much bigger. So people use this as a momentum indicator. They pay close attention to the 0 line. Some traders will take a move of the histogram below 0 as a sell signal and above as a buy. Some will take the crossover as a buy or sell signal. If you think about it, though, that's the same thing as a moving average crossover up here. So it just makes the price action a little easier to follow. And then some will take the moving averages crossing above the 0 line as a buy signal, and that is an exit signal. We're overbought, we've crossed over, it's time to get out. There's also something known as divergence. This is kind of like the Swiss Army knife of indicators. So notice the price is going higher, momentum going lower. That's divergence. That's normally a sign that something's not quite right. You can also have positive divergence, although not as common. So this is negative divergence, showing that momentum's dropping even though price is rising. Just shows you you're running out of energy. The MACD can be used on all time frames, but like with all things technical analysis related, it does tend to be a little bit more reliable on higher time frames. But if you're scalping, that's fine. So notice this little area here of support and resistance, and we closed, I'm recording on the weekend, we closed on Friday just above it. But notice something here. The histogram has gone green, barely. You can barely see it. We're starting to cross again. So that's technically a positive sign. But the MACD would have had you actually getting in maybe at a 0 cross, or maybe at a cross this way. Where do you think we're going? Well, 129 could be a target, and you could put a stop right here just below the candlestick. Looks like it's about 2.5 to 1 on a 5-minute chart. Notice that the overall trend for quite some time has been higher over the last several sessions. So one would think that it's a reasonable trade. Nice volume closing the day as well. So let me go ahead and get rid of that. And let's switch over to British pound, US dollar. So here we have an area that clearly seems to be resistance. We are fading a bit in the MACD, so we'll see whether or not it can break out. But if you get a nice big candlestick there, the MACD confirms that the momentum is changing. Notice right at this high here is when we started to cross. I would also point out that this is an area that's been both support and resistance. So once we break down a little bit, try it again, and continue to drift lower in the moving averages, that's a sign that something's not quite right. We break through support down here, right? Right as we slice through the zero line with the moving averages and the histogram opens up. Very easily could have been a short signal. Obvious stop placement as far as like taking profit, 131 being a big number, might have been a target. So you'd be looking at something like that. So it's about 1.5 to 1. Let's go ahead and switch to crypto. Bitcoin. Now, crypto tends to be very noisy. You're probably going to have to go up to the 15-minute chart. It's really hard to scalp the 5-minute crypto charts. There's just so much noise in crypto, and occasionally liquidity issues. So there's your swing low with the body of the candle right there. Somewhere around here, you'd be looking for a signal. Lo and behold, that's when the MACD really took off. If you followed the crossover, it got you out there. Stop loss above this line. Enter there. That's about 3.5 to 1. You actually had further to go. That's the thing. Are indicators perfect? No. So you could have used it as an entry signal, right? But looked at the chart and said, back here, this is where there was a huge push higher. There is support there, and that's where he fell to. So you really could have made that more of like a 5 to 1, 6 to 1 trade using a little bit of patience, something the scalp traders desperately need. It's kind of ironic. You need to go slow to go fast at times. So that's a quick primer on the MACD. I'll show you how to use it in real trades here in this next video. But like I said, it's kind of like a Swiss tool, a Swiss Army knife. We break down below zero, got a nice spread, we go. The histogram's red, we can go. If we get divergence, we can go. If we get a crossover, we can go. It just comes down to whether or not you have something to kind of back up that signal on the chart itself. Hello and welcome back to the complete scalp trading course by Wealth Education. In this video, I'll run through some examples of using MACD to trade markets. This is Solana on the 15-minute time frame, and I would point out, again, we start with support and resistance. Obvious resistance in this area. We have broken above it. We've retested it. We're just kind of hanging out here. Now, the MACD itself is not the signal, but what it does do is it confirms that momentum is picking up for us. It also tells us when we might want to take profit. Pretty straightforward trade, 3 to 1. Risk to reward ratio ends up being what you end up with. It makes sense. $125 could cause a little bit of resistance just due to the psychology of that round number. And you can see that clearly we had been trying to build up the move higher. Let's go ahead and roll through this chart a little bit. Here is a nice example of previous support, offering support again at, I'm going to call this $105, and then getting a bounce, and then getting confirmation from the MACD. Stop loss, easy placement, right behind the candlestick. Where can we go? Well, one would think, at the very least, here, but you're really looking here. Not much of a scalp. That's more of a intraday trade. The scalp would be here, but then again, you cannot get hung up on the whole terminology of scalp to intraday. They are a scalp is just an intraday trade, but it's for very little profit. I want you to be able to think in terms of where can this go. A scalp trader may take here once we break above there and maybe move the stop loss to break even in order to protect themselves. But this is one of those examples. It could kind of be both depending on how you approach the market. Solana showing resistance here at, I'm going to call it 103.5. Big, huge candle on volume, breaks out. MACD has already gone positive. In fact, you would have been in had you taken the zero cross there, or you would have seen this as a potential turnaround. But either way, you break a major short-term resistance level. Nice volume. Really got nowhere to be until we cross right here. So pretty straightforward. That's about 2 to 1. Not a huge trade, but a nice one. And that's what a lot of the scalping will do. It'll give you a lot of nice short-term gains. Let's go to Apple. I'm going to go ahead and go down to the 5-minute chart. Apple's liquid enough you can trade it. So support here, resistance there. Cross here, right in this support level. Stop loss goes right on the other side of 173. You're aiming for the top here. Granted, it does take about 2 hours to get there. So is it a quick scalp? No, but it is a doable trade. You could have also said, all right, fine, I'm just going to aim for this. That would have been your entry. That would have been a 2 to 1, roughly. This would have been a 4 or 5 to 1. And that's the thing. Again, don't get hung up on the fact that, maybe it took an hour and a half to get there. Slow days, that might be a scalp. Furthermore, the 4 or 5 to 1 gain will help you longer term because not only is it more profit, but if you lose the next 2 trades, you're not going to blow up your account and in fact should still be very positive. You can see there's a nice exit signal as we crossed, kind of lost momentum. That gap higher was your entry. That was the beginning of the day. So on that gap, you put your stop loss down here. You write it out. Ends up being 2.5. Nice positive spread on the MACD. This offering support a second time and a cross right at the zero line could have been your entry. Would have been easy to get there. Stop loss down here. Your entry's right here. So that's a nice 4 to 5 to 1 type of trade. Again, that's what you're looking for. British pound, Japanese yen. This is an easy trade here. So you've seen that we have failed here twice. We run all the way up here and get this cross right here, as we also get a very negative pullback. Stop loss goes above the high. Where do we get out? Well, you could choose this. That would be 2 to 1. Or you could choose this area here that has been support multiple times, which would be like 4 to 1. Granted, you need to pay attention to support and resistance first, and I will pound that into your head throughout this course. I cannot stress enough how important that is. But you can see, used with the MACD, it can really give you a nice trade. Does it always work? No, of course not. But as long as you're aiming for like 2 to 1, 3 to 1, 4 to 1, it doesn't have to work all the time. 50% of the time will be more than enough to make you extremely profitable. In the next video, we're going to take a look at another oscillator. That's what these are down here in its own window. It's called the Relative Strength Index. Very popular oscillator. Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, I'm taking a look at the RSI, the Relative Strength Index. So it's an oscillator, so it'll get its own window down here. Let's go ahead and put it on the chart. You can see I have favored it. And this is the default setting. You get this purple kind of area between 70 and 30, which is considered to be sustainable. Now, once you break out to the upside or to the downside, that's overbought, oversold. Pretty straightforward. You will also have the potential of divergence. So you can see momentum is slowing down while price is rising. That was a sign that we could have fallen. Right here, you can see that was an oversold condition, so we did bounce. And now we've just kind of been floundering back and forth since then here in the SPY. It works on shorter time frames as well. Obviously, the moves are smaller, but you would expect that, right? So, as an example, you may choose to take this candlestick formation as a selling opportunity in the SPYs, and with the overbought condition. Down here, you would get out based upon the RSI saying, hey, maybe we're oversold, and so on. Let's go ahead and take a look at it in action in Ethereum. You can see Ethereum almost oversold right now on the 15-minute chart. Makes sense because if you look at it, we're in a major consolidation era. We broke out of it, got a false throw over, if you will, at an overbought condition, and we have since broken down. With that being the case, it looks to me like if we break down through the support, we'll continue to go further. As things stand right now, the RSI does not favor it, but again, the RSI is not the be-all, end-all of trading. It's just a tool, and you can never forget that. I don't really see too much beyond that on this chart. Let's go ahead and take a look at, let's do a stock here. Home Depot. So here you saw it get overbought. Not a huge surprise because we had been in a downtrend. We shot higher and then we broke down. We're oversold in this area. We're starting to kind of recover here. So, you marry this with a lot of other tools and the RSI becomes quite important actually. A lot of traders like it a lot. Here's a candlestick formation here, which is a selling signal, sign of exhaustion, long wick above. We're overbought. We fell and then didn't get really oversold until we got down to here, which was in the next day. So you can see just how useful it's going to be. The measurement of momentum, the relative strength of the trend, that's really what you're seeing here. If you're in a position and you're like, okay, is it getting oversold, and you're in the middle, that confirms that it is not. Again, doesn't mean it can't turn around. It just means that it's not statistically oversold. So what I'll do is I'll run you through some examples in this next video and with some other things that we've learned already to show you how you can use this in your day-to-day trading. Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, I'll run you through some examples of using the relative strength index to trade the markets. Now, let's go ahead and drill down to the 5-minute chart here in Halliburton. So here is a gap lower. Now, gaps do tend to get filled. So some traders will just take this and try to fill the gap. However, more often than not, and especially in the stock market, they just become massive resistance. So when you look at this, you already know that any move above basically the close of the previous session is going to be very strong. That being said, this could be your target. What do you notice right away? Well, you notice that the volume is very high and we went into an oversold condition almost immediately. So there's your target and there's your entry on what would have been, let me hide the volume so you can see a little better, a very neutral candlestick. This shows that we fell apart, just kind of hung out there, and then got this green candlestick. This 3-bar reversal, if you will, is an entry. Your stop loss is down here, and then you wait until you get to hit that or something close to it if you choose to exit. You certainly want to get out here because you're overbought for a while, and then you start to dip again, go sideways, and the trade essentially becomes dead. So that's a way of playing a gap with Halliburton with the RSI. Let's take a look at Bitcoin. Now, 5-minute charts in Bitcoin are extreme noise. However, you can see that we had rallied from this point here to $47,400. Notice how we're just kind of hanging about, and we keep going into this overbought condition. This big red candlestick here is a sign that we are ready to fall. Where would you aim for? You would aim for this area of support previously. You did get it in about, looks like about 45 minutes. Stop loss would have been easily put here. Once you break this candlestick, you tried to rally first and then gave it back. So you could put your stop loss there. That's a nice, like 4-to-1, 5-to-1 return. The RSI is also used in Forex quite effectively. Notice that, go ahead and pull up a trend line there. Notice that we are rallying here in Swiss yen. Have been for a while, and in fact, you can make an argument for a little bit of a channel, right? Well, notice we got this oversold condition. So this tells you two things. This tells you that if you're long, you should probably think about getting out. We had this channel, and at the same time had this divergence. So that was a sign that trouble could have been coming. So not only did it get you out, it made you aware of the fact that perhaps it was time to start looking either to the downside or get out of your longs already, or both. And at this point, we had formed a topping pattern there, a topping pattern there, and once we started to break down, it should not have been a huge surprise to come back down to this support. Just go ahead and take a look at a couple of other examples. Let's do JP Morgan. And again, there's a gap, overbought condition. We came back to fill the gap. So, like I said, some traders will do that. It's not as reliable in the stock markets as it is, say, in the futures market. But when you're overbought, it makes a lot of sense. You're right here at a previous resistance barrier, right around 143.5 or so. So that was obviously a trade that you could have taken with very little risk. You just let a red bar form, red candlestick form, you put a stop loss on the other side of it. The risk to reward is brilliant. I mean, you were only risking about 40 cents and you ended up with $5. Go ahead and take a look at another currency pair. British pound, Japanese yen. You can see most of the time in this choppy behavior, it's just kind of, even though we're rising, we're not getting overbought by any stretch of the imagination. We do get it there, we pull back, right? We get it there, we pull back. So in this move here, once you break through these candlesticks that are showing support here, you could be making a move down to here. Now, we'll have to see how that plays out, but it certainly looks very possible at this point. And let's do another crypto. Let's do Zcash. Okay, so Zcash, when you look at it, it's in a nice downtrend. Notice that we are threatening this resistance area as we go up into an oversold or overbought condition. You wait for it to start to drift a little lower. You put your stop loss just on the other side of this rally. Where do you think we're going? Right down there to support. That's like a 1-to-5 ratio as well. And it's with the trend. You could look at this through the prism of, are we seeing more volume? And the answer, of course, is yes. So that's not a surprise, just as we stabilize here on more volume. So keep all of that in mind. So with that, we will start to focus on the next oscillator. It's actually called a stochastic oscillator. It's kind of like the RSI and the overbought and oversold condition, except for it's use for a sideways market. Hello and welcome back to the Complete Scalp Trading course by Wealthy Education. In this video, I will show you how to use the stochastic oscillator. So let me go ahead and pull that up. So stochastic, you pull it up and you've got a range much like the RSI, except for here it's 80 and 20, but it essentially tells you the same information. You have, go ahead and pull this up, you have a smoothing K and D indicator. Think of them as moving averages, for lack of a better term. You can change the upper and lower band. Some people do, but we're just going to stick with the standardized setting. So there are different signals. On a moving average crossover, you may wish to go long or short in an oversold or overbought condition. There is also divergence. If you remember, divergence is when price is going up or down and the oscillator is going in the opposite direction. And really, that is the gist of it. However, I will say that the oscillator performs very poorly in markets that are not sideways. So therefore, you almost always see the stochastic accompanied by a moving average. So let's go ahead and put a moving average on this 15-minute chart. Let's make this the 20. And notice how, like in this area, it's pretty flat. In this area, it's pretty flat. So what you see here is a couple of overbought conditions that you could have shorted. For $2 on Zcash. Now, okay, or two tethers, $2. These are not big moves, but then again, it does make it useful for a scalp as we are sideways. Now, as this thing trends lower, the moving average, it becomes a lot noisier. So that's one thing that you do need to keep in mind. And in fact, a lot of traders will use a moving average, whatever they choose, 20, 50, whatever. And then they will use the RSI if it's trending, and they'll use stochastic if it's not. So, you can see a lot of noise there, but if you're just following the trend, it's easier to short it. Here's some sideways action in a relatively well-balanced consolidation area. This was a buy signal here. We got another crossover here, so that would have kept you into the trade. You obviously would want to put your stop below the bottom anyways. And then you get up here, quick scalp, comes back, bounces to the moving average here on Zcash. So let's go ahead and take a look at, let's just do, let's do a stock here. Let's just do Apple. So you can see, again, trending very noisy. But once we get sideways, notice how we're in an oversold condition. That got you in to an existing trend. Trend, consolidate, trend. So that is one way that you can use it as well if you've been in a trend and you're starting to consolidate. Dollar yen, sideways, gets you back into the trade, gets you out of the trade. This is about 60 pips. That's a bit more than the typical scalp, but it does show you how you could have used it. So pretty straightforward. You just want to know that the market is going sideways before you use it. It's basically RSI for sideways markets. So with that in mind, I'm going to do the next video, and I'll show you some examples with some other things. Can kind of give you an idea how to use this in the real world. Hello and welcome back to the Complete Scalp Trading course by Wealthy Education. In this video, we're taking a look at some examples of using the stochastic oscillator to scalp the market. Now, I have the 15-minute chart up. You can use the 5, whatever. It really doesn't matter. It just depends on how quickly you want to get involved. Notice here that we had gone sideways for a minute and we had gotten an oversold condition multiple times. We kind of crossed back and forth in the Qs. Well, pretty straightforward. You just put a stop loss underneath the low here because we are just a little bit higher, and you aim for that. It was very quick. You were in and out for about $3. You risked maybe 75 cents. That's how it's done. That's how you want to do it. 1 to 3, 1 to 2, more if you can get away with it. Trend there, trend there. Let me go back to the 15-minute, so we have to scroll forever. Sideways action here. You had several opportunities to buy and sell in this market through this sideways action. So you could have scalped back and forth in a range-bound system here, $5 range or so. And you can see that there is support and resistance in this area. So there were 4 or 5 trades right there that you could have taken advantage of. Okay, so let's go pound Swiss. Now, this is sideways action, some buy signals, some sell signals, back and forth here in about a 15 pip range. One thing that I would say about the stochastic is it tends to be really good during Asian trading. And that's because Asian trading tends to be a bit quieter than some of the other markets. So, when Tokyo is in play, not so much when London or New York is in play. Doesn't mean it can't trend during those times. It just means that generally we struggle a little bit. Sideways action, oversold condition, you're shorting back into the moving average. You're looking at about risking 5 pips to gain 12. It's doable. This is another kind of back and forth area. You sell there, you buy it back there, you sell there, and you buy it back there. So that probably was a wash, maybe a pip or two. That's a trend, so you don't want to mess with that. So let's go ahead and go to crypto. Let's do Luna. Nice sideways trend there. Consolidation. 3 different areas you could have shorted this market, all of which you go back to the moving average. You take $1 or so each time. Something that you might want to think about as well is if you're consolidating after a move lower. So for example, here you may wish to sell and not buy, so you may ignore the signals to buy, use those as exits. Because we like trading with the trend overall. Now, we will see the stochastic, the RSI, the MACD, the moving averages, Bollinger Bands, support and resistance, yet again throughout the course. I just want to get you exposed to them, understand how to read them, because then when we go into this next module, which is going to be scalping with candlestick patterns, you'll know what I'm talking about when I say, hey, we've got a hammer here right at support with the stochastic oversold. You'll get the gist. So this has been about exposing you to the indicators and the jargon. Now we start to get into the meat of price action in the next video when we begin Module 3, Scalping with Candlestick Patterns. Hello and welcome back to the Complete Scalp Trading course by Wealthy Education. In this video, we begin Module 3, Scalping with Candlestick Patterns. This first video is going to teach you how to read a Japanese candlestick. There's, certainly a need to understand how to read the candlestick before we start talking about patterns. So let's make sure that you understand how this works. In front of you, I have a candlestick chart. You can see that they are red and green. Red means negative, means we fell. In this case, it's the NASDAQ 100 daily. So this day was negative. This day was positive. You also have black and white, black negative, white positive. So why would you use candlesticks? Well, like here, you can see that clearly there's a lot of bullish pressure. These white candlesticks and I'll go ahead and go back to the red and green, show a lot of positive momentum. So how do you actually read this? Well, it's the same thing as a bar chart. If you've ever seen a bar chart like the old stock charts, they have a tick on one side, a bar, and a tick on the other. So, for example, this tick is the open price, and that's the close price. That's the low, that's the high for that day. This tick is the open, that's the close. That's the low, that's the high. Open, low, high, close. Open, high, low, close. Candlesticks tell you the exact same thing. The only difference is they're a little easier to read. There's a lot more patterns based around the candlesticks, although, full disclosure, you can use bars to trade those same patterns. They're just not as obvious. People like the fact that just a quick glance, you can say, okay, well, we're in a downtrend here, right? The real body, now there are some things that matter. The real body, the longer the real body, the more it matters. You'll notice that even though this candlestick has a long body, and we did come back to retest that area, it was the beginning of something rather strong. Notice how, for example, over here, we have a couple of small candlesticks here, small bodies, the open and the close area, long wicks. Notice how all of the longest bodies are all negative, so we fell. Not a huge surprise. What that shows is conviction. That means that between the opening price and the closing price, there was a lot of movement in one direction or the other. It can be green or red. It really doesn't matter. So real body size of the candle is important. The wicks can be important. So for example, we rallied all the way up here on this day and then gave it all back to end up negative. Well, that shows that the buyers could not hang on to strength. And in fact, that is a particular candlestick type that we'll talk about later. The fact that we closed all the way down almost to the exact lows of the day, that's a very negative sign. And you can see we did, in fact, have some follow through. A lot of these candlesticks really don't tell you anything other than we're running out of momentum. While that in and of itself can be something. Notice that we're rallying here and we run out of momentum and we pull back. So it's a matter of measuring conviction, if you will. So with that, make sure that you understand how these things are formed. So you have a body and you have wicks, or you don't. You don't necessarily have to have wicks. That could be the absolute top, for example. But almost all candlesticks either have one wick or two. And then the body, in this case, it would be white. So it means that we opened up at the bottom and rose. Candlesticks they can be quite big and close towards the top or even at the very top. That would be an extraordinarily bullish one. We opened up there and we raced higher to close almost to the absolute top. You would assume, more likely than not, that there is going to be a high probability of follow through on any type of pullback. And we'll get through that as we go through each candlestick pattern. I just want you to understand, looking at the color tells you, okay, well, we opened up and closed down, and that's the high and the low. We opened here, we closed higher, that's why it's green, that's the high and the low. In the next video, we'll talk about hammer and hanging man candlesticks. These are very powerful candlestick patterns, and in fact, there are some traders out there that use just hammer and something called a shooting star, which is the exact inverse. So I will go ahead and explain those over the next couple of videos, but this first one is hammer and hanging man. Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, I'm looking at a candlestick known as a hammer and the hanging man. So the hammer comes in, multiple different sizes, but essentially it is a small body with a long wick to the downside and little to no wick on the upside. So think about what this means. This means that, and it doesn't matter if it can be green or red, really doesn't matter. But what it means is that somebody came in and really tried to push this market lower, but then we recovered. So it shows that sellers are running out of momentum. Everybody who shorted this market or sold it in this area is now losing money. If you break the top of the candlestick, then everybody, in this case, Day and Tesla, is now losing money that got short. They have to buy their positions back, and it pushes the market to the upside. It just shows an exhaustion of selling. That is a hammer. It's called a hammer because you can make an argument for that looking like a mallet, and that, of course, is your handle. Hammers can look like that. They can look more like that. They can also have a tiny little microscopic wick on the top. The idea is that the body is small and the wick is long underneath. This is also what a hanging man is. The only difference is that a hammer is at the bottom of a move lower, and a hanging man is at the move higher. Now, a hanging man at a move that's higher is not technically a hanging man. Say you have a move that you're going higher, but it's technically not a hanging man until you break down below it. So why is this important? Well, what it shows is that the sellers came in and they got rejected. So the buyers are thinking, okay, well, we're ready to go higher again. But all of the buyers here that tried to support the market, if it gets broken below, they have to sell their positions to get out. So it's a sign of exhaustion. It's called the hanging man because it's so doom ridden, as it were. They are not as common as hammers, but they do happen. You can make an argument for a hanging man right here. You can see this huge run in Tesla, and you can see that we had gotten a bit exhausted. We broke down below it and then broke down. You can make this as a hammer down near where we could see support due to a gap. We fell, turned around, recovered, and you can see that we took off to the upside. We fell down this way. We formed a hammer. We rallied a bit. Now, we did eventually go lower, but that did show a sign of a bounce. So you could have taken a long above the top of it and bought there. Same thing here. You could have shorted this on a breakdown below the bottom of this hanging man. You just put your stop loss on the other side of the candlestick. It's that simple. So in this case, shorting it, you shorted there. Your stop loss was there. Your target could have been wherever you wanted, maybe this gap. This hammer, you go long here. Your stop loss is there. Same thing here, and on and on. Now, there's a little bit, you want to have more reasons than just the candlestick, but there are traders out there who literally trade on these candlesticks alone. There's also called the shooting stars, the exact opposite. That will be the next set of candlesticks that we look at. So let's take a look at, let's see, Ripple. Now Ripple forms this is a hammer that has an almost unchanged body. You buy it on a break higher, your stop loss is down here. You can see so far it's working quite nicely. Like I said, you won't see as many hanging mans. You could make an argument that is, but it does get a little negated because we broke above it. So depending on what part of the day this happened, you may have gotten stopped down. Hanging mans are a little trickier than hammers. So, not only they're not as common, but they are a little trickier. This is a hanging man here. It worked out quite well. You just short there, put your stop loss there. We go all the way down to this cluster. So let's go ahead and take a look at a currency. Let's see, dollar yen. Nice hammer here. Now, notice that this is in an uptrend, but we have rallied quite significantly, and you could make an argument for a little bit of a pullback, offering value. So we were falling. Now notice how small these bodies got. So it shows you're running out of downtrending momentum. And now that we have formed this hammer, you break above the top of it, and you get a move all the way up to here rather quickly. So it all kind of ties together. Don't worry, the next video is examples using these with maybe some other indicators, that type of thing. But I wanted you to understand what a hammer looks like and what a hanging man looks like. They look the same. It just hanging man's at the top, hammers at a move lower and a reversal. Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, I'll show you some examples of scalping with the hammer and the hanging man patterns. So this is the Canadian dollar, and you can see that we had a huge run lower and a nice hammer here on the 15-minute chart. Putting a stop loss below the hammer and entering on a break of the hammer led to massive gains and right back up into this area as you would anticipate based upon support and resistance. I would also perhaps take a look at this through the prism of some indicators, and when you get extended like this, we'll want to take a look at maybe Bollinger Bands, and you can see that we definitely broke out of there. And you'll notice that this area here was where the moving average hung out at, and that shows you how we could have used Bollinger Bands, but you also could use other types of indicators. Right here we have the MACD on this candlestick crossing over. We crossed the zero line there, and we're just now, as we come back up to this area, crossing back over. So it does foretell an interesting area. I would also draw to your attention, this happened right above the 1.24 level, so it was a nice large round figure. Let's take a look at Ethereum. 15-minute chart again. You can see a nice hammer here, right at an area that obviously has been important more than once. That is part of our roadmap. Has it been support previously? It has. We have bounce from there. Volume kind of quiet, but it did spike up a little bit during this candlestick, certainly suggesting that we could go higher. And when you look at this from a longer term perspective, you can see this is an area that's mattered multiple times and has offered a bit of buying pressure. Again, you could take a look at this through the prism of just a quick scalp, or you could try to hang on to it. It eventually forms what is known as a W pattern, which is a long-term trade. This scalp here, though, I think you would, at the very least, try to target that area. I would also point out, again, previous support, and you also have to look at it through the prism of the longer-term trend, so you are with the trend overall. That, of course, being one of the paramount things to understand. Let's take a look at a stock. And let's go to Twitter. Twitter has been explosive over the last couple of days. But as you can see, we have seen massive gaps every day. So on the pullbacks, you're looking for hammers. So for example, you break higher there, you form a massive hammer here at an area that has been support. That's a buy signal. Your stop loss comes underneath there. You do get a scare, but eventually you rally and you go back up to this area here. That is a 2-to-1 risk to reward ratio. That's exactly what you're looking for. You also can make an argument that we gapped higher here. Gaps do tend to get filled eventually. We formed a hanging man here. You short the break of that. You put your stop loss up here. You come back, you fill the gap. You're out of this trade pretty quickly. You would anticipate the beginning of trouble right there, so you get in and out of it, perhaps even a breakdown from that. Let's take a look at a couple other stocks. See what we can find here. NVIDIA. So this is a stock that had been rallying quite nicely, but notice this hanging man. We also got a gap lower. So you could short right away with a stop loss here, recognizing that you may fill the gap and go lower, or you could wait for a little bit of a pullback that gives you an opportunity to short the market as well. With that being the case, either way, it looks pretty good, and notice that there is a lot of volume there. So that gap is the real deal, and NVIDIA has been falling ever since. This area here would be a potential target. I don't like the risk to reward, though, so in that case, you're probably looking for something a little closer to here, which you did get. Might have taken you a little while longer than you anticipated, but it did, in fact, work out for you. You can even look at the 5-minute chart. Right here, there's your hanging man, right at the gap. Lower, you hit the target almost immediately. There's your short-term target. Lots of resistance up there. That's about 3-1. So you can see when you see signs of exhaustion, you need to your ears should perk up, because at that point somebody somewhere is in trouble and you want to get on the right side of the market. The next candlestick patterns that we'll take a look at is the inverted hammer and the shooting star candlestick. Same thing, upside down, and I'll explain that. Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, we'll talk about what an inverted hammer and a shooting star candlestick is. So an inverted hammer is simply an upside down hammer. So if you remember from the last couple of videos, that's basically a hammer. So an inverted hammer looks like this, essentially. You know, it can, as you know, it can be unchanged, whatever, but small body, long wick, in this case, to the upside. There's also a shooting star, which is the exact same shape, and it just depends on where it appears. At the top of a run higher, it's a shooting star. At the bottom, it's an inverted hammer. So let's think about, what's going on in this candlestick pattern. Well, what's going on is the sellers come in and push the buyers back. So in the case of a shooting star, when we are rallying, there's an attempt to go higher and we give up those gains. That shows that perhaps exhaustion is coming into the market. You short the market on a break below the candlestick, you put your stop loss on the other side and you let it rip. Now, on an inverted hammer, it's at the bottom of a move lower. And what makes this interesting is that in this case, we're falling, the buyers come back in, and you can either continue, or the more powerful signal is if you turn around and break the top of this. Think about what's happening here. The market's drifting lower, and then during, let's say that day, there's an attempt to drive it higher. Well, what happens if we break above there? That shows real wherewithal. That shows that people are really stepping in to push this higher. They've made a second attempt at it. That's something you have to listen to. On the downside, it's more about continuation. It's not quite as powerful of a signal. So let's take a look at a couple of examples in the wild, as it were. 15-minute chart of Bitcoin. Notice that we are in a range. So I'll click on the painting and rectangle tool. And notice this candlestick. We tried to break out and we gave it up. Ended up driving right back down to that range, as you would anticipate. This could be thought of as a shooting star, but I don't like the fact that the wick does not extend past the previous candlestick. So kind of takes it out of the running, as it were. This is an inverted hammer, which right here, and actually this one is as well, I guess technically, which when we break the top of that, we go right to a previous selling opportunity. Now with technical analysis and with these candlesticks, but technical analysis in general, you will find that the most reliable signals are going to be on the longer term charts, but they can be used for scalping. You just have to be really quick with it. So for example, shooting star there in a downtrend, nice selling opportunity after this bounce. You could, in theory, call this an inverted hammer that broke down. A little bit of artistry involved. There's an inverted hammer. Notice here, there's an area where you would anticipate that there should be support. Support failed. We eventually broke through it. So you can see how that kind of lines up quite nicely. Here on Netflix, You can see a pullback, a rally, a shooting star, and we continue lower. You can see that the market had formed several shooting stars here in this little range. Again, you have to be quick on some of these, but it does give you an idea of how these candlesticks show a potential reversal. And, like here's a hammer, for example, which is what we learned about last time. Well, notice how we dug almost all the way to the bottom of it, and then it went. Here's an inverted hammer after a breakdown. We fell. We kind of dug back into the middle of this range. Your stop loss up here, it ends up working. So the point is, they are nice signals. We, of course, will want to see support or resistance involved, maybe a couple indicators. And that's what I'll go into in the next video. I'll show you some examples in the real world, as it were. Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, we'll talk about using the shooting star and inverted hammer candlesticks to trade the market. So there's some examples here that we'll run through. Here's an obvious one, at least from what I can see, that 117.50 to 118 is offering quite a bit of resistance. We formed this nice looking shooting star preceded by an inverted hammer and a neutral candlestick. So you could have either shorted right away or shorted this candlestick, as it simply confirms what we already see. Where do we think we're going? We're going back down towards support. Remember, markets tend to go back and forth from support to resistance and vice versa. So with that being the case, I like the idea of shorting it here. Let's take a look at exponential moving average. There's the 20. And let's add another one. There's the 9. Notice how we crossed shortly thereafter. So once we broke through the 9, that could have been a confirmation of that candlestick. Notice the previous resistance, obviously. And then if you take a look at these market conditions, notice how the high really isn't higher. Take a look over here at stochastic. Notice the overbought and cross right there. So that is a sign that perhaps we are ready to start falling again. This, let me hide the volume, although keep in mind that volume very high right there. So this inverted hammer being broken to the upside serves as a buying signal, but it also serves as a sign that this previous support has been broken. Crossover, volume, broken support, all looks good. And therefore, you will find that a lot of traders will be entering at that point. And in fact, that's exactly what happened. Let's take a look at Ethereum. Now, Ethereum is a little bit more tricky. Crypto in general is going to be tricky to trade like on a 5-minute chart. So that's why I default to 15. That being the case, take a look at this inverted hammer. Where do we go? We go right here to this previous support level. You could put the Bollinger Bands on, and you can see that we have closed outside of it. And basically, at this point, we're just doing that bounce back to normalcy type of trade. You can see it worked. And as a side note, there's a nice hammer down here that you could have traded as well. So you can see that these things do continue to come into play over time. Let's go ahead and get rid of this support level here. And notice this. I'm going to have to hide the volume again, but notice how we're picking up volume, building a base. People are interested. Notice this candlestick. Now, it's not really a hammer. I wouldn't necessarily call it a hammer, but I would call this an inverted hammer. Breaking above the top of it, we go directly to the previous support. It's a nice little scalp. It does take some time once we get up here. So it's probably somewhere on the borderline of a scalp or an intraday trade. But again, I'd urge you not to get too hung up on those terms. They are somewhat interchangeable. It comes down to a person's definition overall, like an individual definition. Shooting star right here at previous resistance in dollar Canada. It just falls like a rock. Let's go ahead and go back to the 5-minute chart. Forex is a little bit more likely to produce signals on lower time frames than some other markets. They're not, as long as you're with the major currencies, and the Canadian dollar, of course, is a major currency. Shooting star right into resistance, and we broke down right underneath it, touching this next area of potential support based upon resistance. But even if you wanted to go to this one, you could have rode that out. Nice bounce from this hammer, shooting star right into this cluster here. We continue the move lower. Let's go ahead and put on the MACD. You can see that this shooting star was right here, and then we crossed as we ran out of momentum. Something worth paying attention to. This is the 9. We break through the 9 moving average on this move here. So you can see how that worked out quite nicely. The market, like I said, dollar Canada, it seems to respect this 9 here, shooting star after a nice pullback. We fall down to here rather quickly. That's a 2-to-1 trade. Shooting star here, that's probably like a 4-to-1 trade, and so on. You can see that, if you just pay attention to just these candlesticks, shooting stars, hammers, inverted hammers, you get the gist of when a market may change. Hanging mans to a lesser extent. Hanging mans are probably the trickiest of all of them, though. So with that, you've been exposed to these candlesticks, and there are entire systems based just upon these 3 or 4 candlesticks. So I urge you to really kind of study the markets and take a look at hammers, inverted hammers, shooting stars, and hanging man candlesticks. In the next video, we'll talk about bearish and bullish engulfing candlesticks. Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, we'll take a look at bullish and bearish engulfing candlesticks. The engulfing candlestick, bullish or bearish, just simply means that it is a candlestick that there's a gap and then it swallows the candlestick ahead of it. So in this case, for a bullish one, you would have a downtrend or a down move. It doesn't even have to be a big trend. And then you get a gap lower and a candlestick that swallows the previous one. Or maybe 2 or 3. The more the better, really. It just shows a complete reversal of sentiment. And in an uptrend or a move higher, you get something like this. And this last one, of course, would be bearish. And that is a bearish engulfing candlestick. Now this brings up a problem with 2 of the 3 markets that we look at. In order to have a gap, you need to have time in trading stop. So you really only see them technically in the stock market. Although there are candlesticks out there that will tell you the same thing on a 24-hour market such as currencies and crypto. So we'll take a look at that as well. It's a little bit of artistry, but if you read the candlestick the correct way, you can see it's telling you the same story. So here's an example here in Tesla. This was the open of the 23rd here. You can see Tesla's just kind of doing nothing. It gaps lower and then shoots higher. That's a bullish engulfing candlestick. So we pulled back on this candlestick and then there. So how do you trade it? Well, you put a stop loss at the bottom of it and you let it rip. 1040, you start to get a little bit of what is known as a rising wedge. We'll talk about that later. But it is a signal that perhaps you're running into trouble. Either way, that's your entry signal here on Tesla on the 15-minute chart. Again, you're only going to see them 9 times out of 10 at the beginning of a day, or like on the daily chart, because you need trading to stop. So here in dollar yen, this is what I would consider to be a bearish engulfing candlestick. Now, why is that? Because the real body has swallowed the one before it, and the one before it was significant. So this is a complete reversal. Put your stop loss on the other side, drive down towards here. So it's about a 2-to-1 ratio right there in that previous support level. Again, this is not an engulfing candlestick. It doesn't wipe out the body there. Basically, what you're looking for is a candlestick that takes out a meaningful candlestick, or takes out the previous candlestick meaningfully, to use it the same way you would in a market that stops. And over here in Terra Luna, you can see that we have had, like for this would be a bearish engulfing candlestick. You'd be looking for a move down to here because it was support. Put your stop loss there. It's about 1-to-1. That's, at the very least, you want 1-to-1. You really want 2-to-1, but that was a doable trade in that scenario. This candlestick here is not an engulfing candlestick because we had a couple of supportive ones previously. That being said, you did have an entry signal before then anyways. So this is most certainly an engulfing candlestick from this entire area, but not the candlestick before it, so don't get too interested. The hammer here really was your signal. This is a bearish engulfing candlestick because it takes out the body of the candlestick. You can aim for the support here. It worked out quite lovely. This is technically a bullish engulfing candlestick based upon a market that does not close, but you had multiple hammers before that, so you probably were already involved. Right about there is where you'd expect to see some resistance. You hit that almost immediately, and so on. So in the next video, I'll take our definition, be it the word for word kind of black and white version in the stock market, then I'll use how we look at them in crypto and Forex and show you some examples of trades that you could have entered using the candlestick pattern. Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, I'll run through some examples of using a bearish or bullish engulfing candlestick to get involved in the markets. This is the AMD market. As you can see, we have drifted a little bit lower, gapped lower, wiped out the bottom, and then wiped out the top. This is a major reversal signal, and what I find interesting about this is that it happens right here in an area that has been a bit of a support zone. Well, with that in mind, and the fact that we're in an uptrend to begin with, it all kind of lines up quite nicely. We can do a moving average, and let's take a look here. There's the 20, so when we break above the 20, it is a sign that we are going to go higher. Stop loss would go on the other side of the candlestick. You would assume that we go to at least here. Within 1.5 candlesticks or so, you hit your target. You're in and out of the market rather quickly. The euro yen, as you can see, does not close, so that's something that you have to keep in mind. But here's a bullish engulfing candlestick, at least the way that we have to kind of somewhat pseudo define them. And we did rally right up here to this resistance, so you would have expected a little bit of a reversal play there. You also, later on, have the same setup here, put a stop loss above this resistance, and you aim for the lows. And you can see that played out quite nicely. Let's go ahead and put moving average on. Let me go ahead and change this to the bigger one for the short time frames. You can see that the candlestick here broke through that. This one, of course, failed as well to break through it. So that could have been a signal, although your risk to reward probably wasn't as strong there. You go ahead and get rid of that. And let's put up a stochastic. You can see that we had the cross. So it comes down to whether or not you wait for the overbought or not. Your take profit was lined up with the cross as well. And then let's do MACD. MACD tried to cross the zero line, cross there. Right there, you can see we have rising prices, shrinking histogram. So you had a little bit of divergence as well. Solana, as you know, as the Forex markets, has the same issue in the sense that it doesn't really close. But notice that we have this obvious support level here and this engulfing candlestick. Well, that's a simple breakdown. 130 is the top of this range, so you put your stop above 130. And where can you go? Well, you start to look for a support level, and you see it right there. So it's a quick, I'm going to say 30 minutes scalp here, in what would be relatively steady conditions. It's not like a major blowout or anything, but you can see how that came into play. Let's go ahead and put a moving average here. And you can see that it follows right along with the 9. And let me go ahead and put the other one on. Let's make this 20. And yeah, you can see that they are fanning out quite nicely. So if you're using the crossover trade, you would have already been in it. But you can see that it shows that there's a lot of momentum, and we just simply drift much lower. So that's the thing about these candlesticks. They show a reversal, a surge in the other direction, and that's something worth paying attention to. And it's especially valuable in a situation like this where we have broken through support and it's going with the overall trend, because you can see Solana had been falling for some time. In the next video, we'll take a look at something known as a harami, means pregnant lady in Japanese. It is a candlestick pattern that is a 2 candlestick pattern. It also needs a gap, so we will use our revised rules for crypto and Forex, but we will certainly take a look at that and show you some examples following that. Hello and welcome back to the Complete Scalp Trading course by Wealthy Education. In this video, we'll talk about bullish and bearish harami candlestick patterns. Now, harami means pregnant lady in Japanese, roughly translated, and what it looks like is a larger candle followed by a smaller body candle. You technically need a gap to form this little one. It can be either color, but what it suggests, for example, if you're in a downtrend, it would suggest that you were continuing the downward pressure, but the next day you gapped higher and just kind of hung out. The idea is if you break the top of the 2 candlestick pattern, it's time to go long. You can put the stop loss either on the other side of the mother candle or the baby candle. If you're in an uptrend, this would be a bullish candle and it would look very strong. Then the next day it just kind of sits there. If you break down below here, you put your stop here or here. It's up to you. And then it breaks down. It's a sign of exhaustion. Now, the first obvious problem we're going to have is if you're trying to scalp it, you're not going to get that many gaps. So there is a workaround for that. And it's also a problem in 24-hour markets, crypto and Forex, for example. So here is an example on a daily chart on the SPY. So you see it does happen, but it makes more sense that it will happen when markets have the ability to open close. Here's one in theory, except for it had a long wick that broke down through this body. You want to stay within the body of the mother candlestick. Now again, we will modify this for our scalping. So let's go ahead and let's drill down to the 5-minute chart here in the SPYs. And as you look along the candlestick patterns, you can make an argument for this being similar to harami. Now, when you're trading shorter time frames, no gaps, you have to look at it. You have to include the wicks of the candlestick, and the body has to be within the previous body. That's how I'll approach it. Stop loss goes up here. You short it. You look for a move down to this previous Support, you got there in about, it looks like somewhere in the neighborhood of around 35 minutes. Took a minute, but you did get there. Let's go ahead and take a look at, let's just look at Ethereum. Now again, this market doesn't close, so you're going to have trouble with finding a picture perfect Harami, but you can make the argument that this is Harami here. You can see both of these are within the mother candlestick. It was a nice pullback, so it should be a bullish Harami. And what I like about this particular setup is that it goes with the overall trend. So you break above the 2 candlestick pattern, you aim for resistance right above, or you could have even aimed for resistance up there. Either way, you're in and out of it, 15 minutes at the most. Nice quick gain. And of course, currencies are going to have the same issues because they don't shut down. Although you can get them at the open on Mondays. So while it's not impossible to get a true Harami on the daily chart, it doesn't happen often. Like I would probably have to go through years of price history just to find an example or two. So this is a bearish Harami. You can see a massive shot higher in an uptrend. I'd also notice that there's a lot of resistance there. This candlestick showed promise to be the baby of this pattern, and once you finally break down below this, it falls apart. So you can see with a little bit of artistic licensery, we can use this in scalping. It's not a pure 100% traditionalist way, but it tells you the same story. So for example, you have a pullback here. We're within this candlestick. We break above this candlestick. That shows a turn in momentum, and you reach this resistance rather quickly. Your stop loss would have been there. That was about a 1.75 to 1 risk reward ratio. So it can be used. Quite often what you'll see is that the Harami ends up being another pattern as well in the big scheme of things. So it all kind of ties together regardless. In the next video, I'll show you some examples of using this in the real world with maybe some other indicators and helpful tools to really kind of solidify the trade. Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, I'll take a look at some examples of scalping with bullish and bearish Harami candlestick patterns. So this is the Aussie dollar on a 5-minute chart. This is interesting to me, this setup, because it happens basically at the 75 handle, which support and resistance does tend to be interested in these levels. You can see that there was a dip down to this level here previously, so that suggests that maybe this is more or less a zone, and it's only 5 pips, so that should not be a surprise. Well, notice later on we get this pullback here, we bounce and we pull back here, and that is actually the Harami right there. Let's take a look at the possibility of where we could go. Well, the first thing you think is, okay, well, if this does end up being a double top, this has to be broken. So traders are going to try to push it down there and test it. And that's exactly what happened. So you had about a 3-to-1 risk to reward ratio with a relatively small move. You only had to risk a couple of pips to get something like 7 or 8. And, let's take a look at the relative strength. Notice, got right on the edge of overbought here, but notice how price rallied again, but we ended up having divergence. If you remember in the RSI and the other oscillators, divergence was something to watch. So this is a nice little example of the currency markets being scalped using a Harami. So let's go to NVIDIA. And this is a nice little Harami. And notice how we gapped lower. So one would assume that is the open of the next day. and we just broke down rather significantly. So this area right here should have been support, so I'll go ahead and mark that with a line. Right around 271 or so. You would have had your stop loss here at 274.26. So once it gapped like that, that fired off that move, and within 5 minutes, you're in and out of the trade. That's a truly strong scalp. And once you break through there, you get a huge move, obviously. But as as a scalp is concerned, that's a pretty nice little opportunity. Let's take a look at the MACD. Notice we're crossing right there. We're crossing the zero line. So that is your sign on the MACD that the market is starting to roll over. It's also worth noting that there was a lot of resistance in this general vicinity. So it all kind of ties together quite nicely. So let's go to crypto. Let's check out Solana. Now, this is an interesting setup here because this is the Harami that I'm looking at right there. But notice what the market did before then. That is what gets your interest peaked, because this was an area of resistance, and yes, it was noisy previously, but notice once we broke through it, we turned around almost immediately and just shot straight up in the air. We pulled back, and then we stuttered a little bit there. So what that tells me is there's a lot of volatility in the market, and we're trying to decide who's going to win the argument. Once you break this pattern, it's an entry. Your stop loss is down here. You did get threatened, and it would have been a little hairy to hang on to. But certainly we made it up to here relatively quickly, which would have been your next obvious resistance area. You could have been a little bit more aggressive in taking your gains there. I don't like the risk of reward, so I would have been aiming for that. Kind of pulled back a little bit, ended up taking about maybe 45 minutes, so it was kind of a slow scalp. But depending on the time of day, Solana may not be as active either, so you do have to keep that in the back of your mind. The most obvious indicator that I can think of in a situation like this is we're clearly oversold in the Bollinger Band and we snap back. So that right there tells you we should see at least an attempt to get here, and we did. And then eventually, once we broke above it, one would think that we are going to go higher as the moving average turns. Right here at the target is when you start to break out of the bands. So the Bollinger Band is telling you to get out. It's worth noting that there was a huge surge in volume at that point. Volume kind of chilled out here, and then we took off again. So a nice little setup in Solana based upon a bullish Harami on a pullback after a massive shot higher. So, it's just simply a momentum play, which a lot of scalping ends up being. So in the next video, we're going to take a look at the dark cloud cover and piercing candlestick patterns. Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, we'll talk about dark cloud cover and piercing candlesticks. So dark cloud cover is a reversal pattern where you get something like this in an uptrend. So you get a gap higher and then you get a close somewhere, roughly in the middle-ish of the previous candlestick, and then hopefully you get a little bit of confirmation. So the idea is that you short the market at the bottom of the two candlesticks, you put a stop loss on the other side, and you let it go. A piercing pattern is the exact opposite. So this would be negative. In a downtrend, you would gap lower, which you would think that shows continuation. Then you turn around and close right around the middle, maybe a little bit above it. And then you get a confirmation candlestick. Same thing. Put your stop loss at the bottom of the two candlesticks. Take the trade on a break of the first one. Now, this is going to bring up an obvious question. Well, how can we get that in a 24-hour market? Or, for that matter, how can we get that on a short-term chart? And the answer is we can't. But there are some examples, that are relatively close in a way that we use these patterns on short-term charts to give you an idea. So this is Netflix. We gapped higher and we closed well below the half-point start or halfway point of this candlestick. You break down below it, you have a stop loss, and you can see it went much lower on the daily chart. This gap lower, we broke higher, we closed within the candlestick. That is a piercing pattern. Again, though, you're going to have to use a little bit of an imagination, kind of artistic license with shorter term charts. Here's one, Netflix 15-minute chart. You can see it ended up being a double top. The market did, of course, sell off. So that wasn't a bad setup at all, really. You can see that here's a Harami, if you remember that from the last video. You can see that this candlestick ran lower and pierced the middle of the bottom here, or the middle of the previous candlestick. You could think of it in the same way. You could also call this a hammer or just simply a neutral candlestick that broke to the upside. So, like I said, there's a little bit of artistic license involved in this. Here is a piercing pattern. We gapped lower by a tick or two, I suppose. Came back in the middle. We rallied right up into this resistance before taking off. So Bitcoin, you can see that we broke higher and then closed right in the middle of this candlestick. You break these two candlesticks. That is a pseudo dark cloud cover. Like I said, you have to use artistic license, but we did come back down to here. So essentially what you're looking for on these short-term charts would be a setup that looks like this. Not necessarily shooting stars or hammers, but a rundown and then a recovery back into the middle of the candlestick. So we kind of tried to ran it up there. I wouldn't necessarily call this a dark cloud cover, though, because we did not go beyond. If anything, that's what is known as a tweezer top. But you can see where, like here we may have, it looks like we ran a little lower. We came halfway. That's a nice piercing pattern. Set up Bitcoin to go higher. Again, you have to understand the psychology of the candlestick as much as the exact shape, because, like, for example, that candlestick's bullish. There's no two ways about it. Whether or not it's technically a bullish engulfing candlestick really doesn't matter. So that's kind of how you're approaching this. And, in a lot of ways, I think that is something that's lost on a lot of new traders. They don't understand that the candlesticks, pretty much each one is trying to tell you something. So while this is a hammer, you could also say it's a piercing pattern, both of which are bullish. So there's really no point in arguing about it. It's a signal to start buying. Same thing here. Maybe a bullish engulfing as well. This is a potential piercing pattern. This is a dark cloud cover pattern. Like I said, you have broken the range here. You come back within basically the middle of the candlestick to close right there. You definitely pierced lower than that. So just listen to what the market's telling you, and it'll give you a bit of a heads up. So in the next video, what I'm going to do is I'm going to run through some examples with support and resistance, some indicators, that type of thing, to show you how these trades may have set up in real life. Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, I'll run through some examples with dark cloud cover and piercing candlestick patterns. And as you can see here in the Canadian dollar, we rallied a bit outside of this range and closed in the middle of it. We confirmed on a breakdown below here, and we went much lower. So the question is there a reason why you may have been kind of paying attention in this area for resistance? And yes, there is. an area of obvious resistance multiple times on this short-term chart. This is a 15-minute chart. And you can see clearly that once we broke through here, we went right back down to the previous support pretty quickly on a 1-to-1 trade, and then even made it down here, which would have been more like 4-to-1. You gain 4 for the 1 that you risked. You can also pull up an oscillator like a MACD, and you can see that as price was rising, we were drifting lower, so that would have been a sign of potential divergence, and it did in fact show itself to be just that it was divergence, and you had a situation where the buyers came back in and really kind of stepped up the momentum. So here is a piercing pattern. We dipped down to here in the green candlestick, came back and closed all the way up here. Very interesting particular setup here, because I would anticipate, let me get rid of the MACD here. I would anticipate it's very likely that the Bollinger Bands are going to show overbought. But what I also find interesting here is that you see this inverted hammer. This was a shooting star at the moment, but once we break above there, it becomes an inverted hammer. And that is also a buying opportunity or buying signal. And we went right up here to this previous support level. So pretty quick trade. That might have been about 45 minutes. Again, scalping intraday, there's kind of a fine line. If you're trying to pick off 1 or 2 points, that's the ideal scalp, but the reality is most don't work out that way. So Apple, you can see that as we continue, we peaked above this candlestick, stayed right in the middle of it. I would also pay close attention to this shooting star for this dark cloud cover. You get the confirmation right down here. You break through these candlesticks, and then you go right back into this area rather quickly. So we can put, let's see, let's get rid of that. Go ahead and put moving average on, and you can see that the 9 got broken through pretty quickly. So once you break through that, does suggest that the momentum is starting to turn against you. So as we go further into this market, wrong direction, sorry. As we look further into this chart, here is an example that could be thought of in the same sense, because this was an inverted hammer. We broke down and we closed in the middle of the wick of the overall trade, broke above there, and then obviously it was time to start buying. You'd be aiming for here, about a 1.5 to 1 ratio. Not the greatest ratio, but certainly a doable one. This is a sign of a piercing pattern. We break the top of it, which happens to be right at the 9. Where are we going? Well, look for a ledge of resistance. So it took a couple candlesticks, but we finally ground our way up there. And let's take a look at some crypto here. Luna. As you can see, we broke higher. We closed almost at the bottom of this candlestick. It almost negated itself. But by the time you get the close on this one, there's no doubt that we're going to fall. Stop on the other side of the candlestick pattern. And you can see we went right down to the support. Again, it may have taken 45 minutes, so it's not a couple seconds type of trading. But at the end of the day, it does fall within the purview. I'm going to jump down to the 5-minute chart. You can see here's the setup right here. We broke higher. We closed right in the middle of this candlestick. We broke through this one just barely in the previous the next candlestick, and then took off. So on this 5-minute chart, you could have had a stop at about 95.40. You'd have been aiming for right around 94.60 with an entry of 95, maybe 94.90. About a 1-to-1 trade. It's with the trend. So the idea is if it's with the trend, you probably get a little bit more. So maybe you're aiming down here to 94. 40 or so right here at the top of these candlesticks, but either way, you are going with the trend. The area here that we take the trade in, we take a look at the MACD. You can see that we did cross the 0 line and started to cross again to show signs of exhaustion. So again, another setup. You have to use a little bit of imagination in these patterns that technically need gaps, but you can read the candlesticks in the same way, and that's the whole point of the video. In the next video, we'll take a look at the morning star and evening star candlestick patterns. Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, we'll take a look at morning star and evening star candlesticks. So the morning star is a bullish pattern, the evening star is a bearish pattern. And the best way to describe it is drawing out the bodies like this. The idea is that in this case, this would be a morning star because it's going to rise. You would get a gap lower for the second day because you need gaps, and then you would get a gap for the third day to turn things around and show signs of life. If we can break above all three candlesticks, you put your stop loss on the other side and you let it rip. It's supposed to be a potential reversal. Something like this is what you would want to see on an evening star. So you would have negativity on this candlestick. It can be either color up here, and obviously it would have to be bullish. Stop loss goes on the other side. You short the break of the two other candlesticks, and you let it rip. Now, obviously, you're going to have to use artistic license because we don't have that in 24-hour markets. So this would be a morning star after a pullback. You don't have the long candlestick ahead of it, but it does tell you the same thing. But at the same time, you can say, hey, look at this nice hammer here. So you're going to run into a lot of that with these patterns. But I want you to at least be aware of the fact that something like this exists, and you can think of it in those terms. So in this scenario, you would buy on a break above this. Your stop loss would be down here, and you can see you took off on the daily chart, and the next resistance barrier is right up there, and there you go. So let's take a look at some 5-minute charts here, for example, in Home Depot. Because you don't have the gap, this candlestick here can be thought of as an evening star. It also can be thought of as a shooting star. So it's kind of 6 1/2 a dozen or the other. Do you really care what you call it, or do you want it to work? And that's kind of my thought process here. You would short it there, stop there, huge area, obviously. Right here is your next resistance barrier, or support barrier, excuse me, and you hit it, and then lo and behold, you do the same thing down here, and this is an actual morning star. You can see you gap lower and then turned around, so you buy on the entry there, you stop loss there. Where do you think it's going? Well, you would assume it's going to at least there, so it's at least 1-to-1, or you could try to take out the tops. So you can see how that plays out. Over here in dollar yen, again, you're going to have to use a little bit of an imagination. Big run higher, little star, decent body. You break down below it, your stop loss is here. You go down here to the previous resistance, which should now be support on this evening star. So again, like I said, you're looking for the spirit of the pattern, not necessarily the exact perfect 100% setup, because like I said, you're not going to get it in a liquid market that never closes. You could call this a morning star. You buy the break of that. You got to be looking for that area there. It takes a handful of candlesticks to get there. With your stop loss, you're in pretty good shape. So let's go over to crypto and check out Tron Tetherus. Here is an evening star or a shooting star. Take your pick. It's right at resistance. You sell the break of that. You're looking to come back to this previous support level, and that's exactly how it plays off. So again, don't worry about the perfection. Pay attention to what the market's trying to whisper to you. This is one of those subtle signs. because we don't have the massive gaps that you would have like on a daily stock chart, as it were. So the next video, I'll run you through some trades and I'll show some indicators and technical bits and pieces that could make the trade a little bit more comfortable for you. Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, I'll show some examples of scalping with the morning star and evening star patterns. Now, again, keep in mind that we have to use a little bit of artistic license in these patterns, but we do have the ability to trade them, or at least an amalgamation of them. So Dogecoin, 15-cent level, an area that would attract a certain amount of attention, as you can see multiple times. We ended up shooting higher and then pulling back after a shot higher, so you could call this a evening star. Where would you like to go to? You'd like to go down there. Did break here, and then you kind of had to sit on it for a while. This was about 25 minutes or so, and then it broke down. So it wasn't exactly a quick scalp, but it did give you a little bit of a heads up. In this type of trading environment, you can see that the stochastic had not only got into the oversold area, but it started to drop while price was still rising. So a little bit of divergence there as well. So this evening star, of course, would have attracted a little bit of attention. So let's go to Facebook. And you can see that, notice how we had been falling pretty significantly here. Then we turned around to make a big move. We pulled back and formed this pattern here. That would have been a morning star. So the first thing I would look at is there was a little bit of support there previously as well as resistance. Not anything major, but it's an area where you might see a bit of a reaction. So do keep that in mind. You would also start to look at your moving averages. So this is a 9. Notice how the star itself touched the 9, and then we broke above there. So that candlestick there was a continuation. Stop loss goes there. Once you can get above here, then you can really get going. Now that's the thing. You would have had to have been willing to ride it for a while. That's an area that I would have been interested in trying to target. So that candlestick essentially got there. Not quite 1-to-1 though, so not the best setup ever. This area here would be a target. That is a little bit more doable. That's 2-to-1 and then 3-to-1. So it really comes down to how long you're willing to hang on to the trade. But you can see you did get that setup there. And that's one of the troubles that you can run into when you're trying to scalp is sometimes you have to just simply let things go because you're like, hey, I've got a less than 1-to-1 shot. And that is an account killer. So scalping is very difficult. It takes a lot of patience, which is something that people don't really talk about. Here is an evening star. So if we can break down through all of this, that candlestick, and that candlestick, and we finally do a candlestick or two later, you can make a little run to here. That's exactly what happened. Your risk to reward 1-to-1. You could, if you wanted to be a little more aggressive, try to press it down to here. But then you're starting to talk about a 2-hour trade. It might be a little bit much for a scalp. So let's see. Let's do Forex. Pound yen. This pair extraordinarily volatile. You can make out the evening star set up here. You can also call it a shooting star, so you could have gotten in there. But if you decided to wait for all of that, you had to wait for about 15, 20 minutes or so before everything kind of kicked off. Would have been right there. Your stop would have been there. Where do you think you're going? Right down here. Pretty straightforward. And in fact, once it actually kicks off, then once you've broken through all of this, then you're looking at a pretty significant sell-off in what looks to be in about 12-ish minutes or so in that evening star. evening star right here. Got to break through that first, which coincides with this previous resistance. So you can see that. Or previous support, I should say. So let's go ahead and mark that area out. Right there at that candlestick, we broke higher, failed here, formed the pattern there, pierced this, came back all the way up to here, found resistance again. Your stop would be there. And then that beautiful candlestick there really got things going. You would have hit a target there pretty quickly. And then this target here about a half an hour later. So let's go ahead and remove all the drawings. And now the crypto. Well, let's do a stock. GameStop. So GameStop's not as liquid, so you get a lot of gaps here. So technically this here would be an evening star. Support, resistance, resistance. So that's an interesting little setup there. Let's get rid of the EMA. Let's pull up the Bollinger Bands. And we did, in fact, gap above the top of it. At the very least, if you use a Bollinger Bands as a guide, you're looking to hit this 20 SMA. So that's your target. That's your stop loss. And there's your entry. So a nice little setup, 3-to-1, pretty quickly hit. And as a result, easy trade. So what I also like about this is it goes with the overall selling of GameStop. So with that, we're done with module 3, which was scalping with candlestick patterns. The next video, we begin module 4, scalping with chart patterns, looking at something called a double top and a double bottom. Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, I am starting module 4, scalping with chart patterns, looking at a double top and double bottom pattern. Now, a double top and a double bottom is simply when the market does this, in the case of a double top, or this, in the case of a double bottom. Basically, it's an area within a few ticks, hopefully, or even at the exact same price that the market cannot break through. So a double top, obviously very bearish. It shows that the sellers are taking over, and typically you draw a line to form an M. Sometimes it's called an M pattern, and you short it there. You put your stop loss on the other side, and you're looking for at least that type of move from the measured, from the top to the line. The W pattern or double bottom, same thing except for it's bullish. And you put your stop loss here, and you take a breakout, and you go from there. It just shows where the market cannot break through. These happen quite often. Here's a double top on the 5-minute chart in AMD. So you can see 108 is an area that was previous support. It's now showing resistance, and it at this point in time kicked off a sell signal, and you can see very easily got your measured move and much more. So here in the British pound, here is another double top. That's all the way over here. And here you can see that we kind of did this and then broke down. Again, it's an area at 130.5 that cannot be broken. So obviously a very bearish sign. Now here is a double bottom. A couple long candlestick wicks. And that was a bullish sign. It went right up to the resistance. So you see this happen quite often. And part of the reason I think it's so powerful is because it's so obvious. You see it happen quite often, and therefore a lot of traders will jump on the bandwagon. Here is a double top on the 30-minute chart in Ethereum. And you can see we did, in fact, break down. You can make an argument for this being a double bottom. Broke above here, and we took off to the upside. So double top, double bottom. Both very simple patterns, very powerful patterns that catch a lot of attention. So in the next video, I'll run through some examples using other indicators along with a double top and a double bottom and show you how it's used in the real world. Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, I'll run through some examples with double top and double bottom patterns. So you can see there's a little bit of a double top right here in Luna. This is the 15-minute chart. The reason I'm using the 15-minute chart is on these smaller coins, it's really difficult to get clean signals on 5-minute charts. So you can see that this is an area that had been resistance multiple times and we formed the double top. It's also worth noting that right here is the bottom of this pattern. So it's a $2 pattern. It ended up getting almost $4. Pretty impulsive move to the downside. Let's take a look at your moving averages. So there's the 9. We break through that and then it starts to slope lower. So that gives you also yet another idea as to that, there could have been some issues. And let's take a look at an oscillator. So you've got the stochastic crossing over at this peak here. We rally a bit and we actually go a little bit higher, and notice how the moving averages are lower. So you're seeing a bit of short-term negative divergence as well. So, clearly something is going on there. So here's a double bottom. And while it is not just 2 candlesticks, it's 2 impulses lower. And that's the same thing. So keep that in mind. It does not have to be a situation where it's just 2 candlesticks. This is the line here for the W pattern. You can see that the 9 started to rally. So let's take a look at the 20. And notice that we got the crossover here, and then they both started to spread out as we took off above that signal. So that in and of itself probably gets you involved. But let's take a look here and see the stochastic again, because it is somewhat sideways. Oversold, you're a buyer, and it breaks out. So good look there. Just at the $90 range, so that of course captures a lot of attention as well. Let's take a look at a stock. Let's do PayPal. So PayPal has a bit of a double top at 122 right there. And you can see that later it did in fact influence the market as resistance. So let's see, where we were in reference to the overall health and all of that of the market. You notice that the Bollinger Bands are rolling over and we have closed outside of it. So that would have had people shorting it. You also would notice, let me get rid of the Bollinger Bands, that if you look back, that this was an area that was support and resistance. So that might have been reason enough to get involved as well. And let's take a look at the RSI. We had been overbought for some time, started to fall apart, and then we really broke down. So your double top breaking here, you easily filled the gap. That's something that you see a lot on charts. On a gap, it gets filled eventually. So that was a really nice setup and one that really gave you no issues whatsoever. So let's go to Forex, do New Zealand dollar. I see a double bottom down here. It's not perfect, doesn't have to be, just close. There's a wick there. Let me get rid of the volume. It really doesn't work as well in Forex. There we go. So 0.69, double bottom, we bounce and we go higher. Here is the top of the W pattern, the previous support level, makes a lot of sense. We actually break it there. We pull back into it and then take off. So again, this is something that you have to be patient with, and you have to realize scalping, the idea is that you get in and out very quickly, but you don't all, time is a man-made construct in the sense that price will go to where price will go, and price will only get there when the market decides it's going to get there. So while if you took this, and you decided, hey, I'm going to go for here, or I'm going to go for here, whatever your target was, or even all the way up here, you can't jump into it and say, okay, well, I'm going to give it 5 minutes. That's not how it works. A scalp is just shortened real estate. Now, if it was more of an intraday trade, you had a lot more in the way of profit here, but you can see how it did end up supporting you on the 15-minute chart. Forex can be done on the 5-minute chart as well. But again, you have to recognize that, like right here, this double bottom and that resistance, that's a nice little setup. But you have to recognize that you don't decide when the market makes the move. You decide where it could, maybe, but not when. So nice setup there. Let's take a look. Moving averages cross over there and we go higher. So let's go back to that 5-minute chart. Right here at this little W, 68 is just below. So it's an area that you might see a little bit of profit taking. A W, a crossover right there at the same time. And I'm willing to bet oversold condition. And we started to rise. So a lot going on there. Makes a certain amount of sense that we would, in fact, see a bit of a reversal. So you can see that, in a more liquid market like currencies, it's easier to do 5-minute scalps. And in this case, you got in and out in about 10 minutes if you just aim for that. So with that being said, let's go ahead and move forward in the course. In this next video, we'll start to talk about head and shoulders patterns. A lot of people like head and shoulders. There's also the inverted head and shoulders. I'll talk about both. These are very common patterns. Hello and welcome back to the Complete Scalp Trading course by Wealthy Education. In this video, I'll take a look at the head and shoulders pattern as well as the inverse head and shoulders pattern, because there are both. A head and shoulders pattern is bearish and an inverse is bullish. So this is the classic head and shoulders. You are in an uptrend or rallying. You see a higher high and a pullback, which is something that you would expect in any trend. You see another high, which is higher than the one before it, and a pullback. But the third is lower than this one. So it shows that we are suddenly starting to run out of momentum, possibly. So left shoulder, head, right shoulder. There is what they call the neckline. You basically draw a line and connect these 2 points, and that determines your entry. So the idea is you're running out of momentum, and once you break down through here, everybody that's involved in this pattern to the long side is now losing money. You put your stop loss on the other side of this shoulder and you let it rip. Measured move of the height of the head down to the neckline. So if that's, let's just say it's, $30 or 30 pips or whatever, then you're looking for 30 to the downside. The shoulder basically ensures that it's going to be roughly 2 to 1. It's not always. Sometimes it's more. Sometimes it's a little less. There is the inverted head and shoulders, which, as I'm sure you can imagine, is just simply the exact opposite. You put a neckline there, you go long, you measure the height of the head, and if it's $11, then it's $11. Now, I would say also that head and shoulders patterns don't have to be straight up or straight down. They can be somewhat angled. The idea is that you have a market that is running out of momentum. So here is a head and shoulders pattern. You can see that we pulled back here, we went higher here, and we pulled back here. So if you take the neckline right there, you can see that we clearly had that neckline break. There's your measured move, and we clearly hit that. So it is a reversal. We went higher as you would anticipate, pull back, not a big deal in an uptrend, made a higher high as you would expect, but then ran out of momentum here. And once we broke through the neckline, everybody is losing money. You could make an argument for a very weak inverse head and shoulders. But I actually have a better example on this chart here. This is the euro. And you can see we made the head and shoulders. Now, the question that you'll get sometimes when you're showing this to somebody is, they'll say, well, what about this? So your neckline is there, and you really didn't break it until you came over here. But you have kind of this look. Well, that's what's known as a complex shoulder. Doesn't have to be just one. There can be two. And, sometimes you'll see like this as well. You worry more about the spirit. These would be complex shoulders. You might have one on one side and two on the other. But you're looking for a peak in the middle and a running out of momentum. These patterns are widely followed. A lot of people pay close attention to them, and therefore they do tend to attract a lot of attention. Higher time frames tend to be a little bit more reliable, but they can be used to scalp small positions. Like I said, you don't always see them straight up, straight down. You could argue that this is a head and shoulders here because it is slightly higher at the peak here. You could also just call it a trend line break because that's essentially what the neckline is it's a trend line. So in the next video, I'll show you some examples using real world indicators, setups, that type of thing, to show you how you would have traded it in real time and in the wild. Welcome back to the complete scalp trading course by Wealthy Education. In this video, I'll run through some examples of scalping with head and shoulders patterns. So this is Dogecoin. You can see a shoulder here, a head here, and a shoulder there would be our setup. So you can draw your neckline there, or you can even go complex if you want and do it here. Either way, you do get your target, so it really doesn't matter however you choose to draw this head and shoulders. You can see that we fell to this cluster of support here. Not a huge surprise that the cluster of support would come into the picture. You can see the 9 EMA has started to break down through this in this neckline. Clearly, at this point, you should recognize that the 20 should show similar behavior. Nice fanned out, as you can see. And we take a look at the MACD, and you can see we cross the 0 line right as we make this shoulder, and then it starts to spread out even more. So Doge definitely showing signs of this working out quite nicely. Euro Aussie, another head and shoulders pattern right here. Now, I would point out that we're right here at a resistance barrier. We failed a bit, so that does show a little bit of hesitation. When you have the Bollinger Bands, you can see that we did break out of this area. So it led to a nice run lower. I'm going to go ahead and hide the Bollinger Band. It does tend to clutter up the chart. That's one thing you have to be aware of. And really at this point, again with the moving averages, you can see the 9 breaking down. And over here, we'd have the 20. And it should be spreading out at that point as we break this line. Your target was basically right there, right at this support level. And you'll see that quite often. You'll see that the previous support levels just happen to be the target. It's kind of weird how it just ties together so nicely at times. Now, Tesla has an inverted head and shoulders. Now, what I like about this one more than anything else is the fact that it is a continuation of the move higher. It's just a pullback there. Let me draw this a little better. And you can see that we build up the momentum. And at this point, I like the fact, like I said, that it is with the overall uptrend. You can see that we shoot higher shortly thereafter. Based upon the 9, this would have been a really tight and short scalp, and that's essentially where we ended. You can see you could have taken profit at the end of that session. We gapped the next day. Let me go ahead and hide this. And you can see, you can probably gather that this is a Bollinger Band squeeze, and that's exactly what it was. So not only would you have hit your target, but you could have really rode that quite a bit higher. So in the next video, I'm going to take a look at something called a cup and handle. It's kind of it's a subtle kind of transition from downtrend to uptrend. There is an inverted version of it. It's not quite as widely followed, so it does not tend to work as well. But in the video, we'll take a look at that, and we'll see some real-life examples as per usual. Hello, and welcome back to the Complete Scalp Trading course by Wealthy Education. In this video, we'll take a look at a pattern called the cup and handle. Now, the cup and handle is a bullish pattern, and essentially what you're looking at is a rounding bottom where you've been in a downtrend or you've pulled back and you've kind of rounded it out. Then you form a little bit of noise here, which would be the handle of the cup. Think of it almost like a channel of consolidation, and then you break above there. Now, what this shows is a gentle change, a little consolidation, and a little follow through. The stop loss is placed on the other side of the handle on the breakout, and you measure the cup itself for a projected target. So, for example, if it's, just say it's $10 on a breakout above the top of the handle, then you have a $10 move. So think of it this way. It's supposed to be like with the old teacups and the handle. Same idea. So this is one on a daily chart that I wanted to show you because in the wild, it doesn't necessarily look as straightforward as that. So take a look at this, and there's your little handle. So it's a rounding pattern. We did, yes, get a gap there in the middle, and I've turned off the turned the volume to blind so that you can't see. There's a bunch of noise right there. You can see where the spike, lots of volume, kind of pulled back. We kind of consolidated here, and so you measure that depth of the cup, and there's your target, and you can see that's essentially where we hit. So pretty straightforward. Cup with handle doesn't happen all the time, but it is something that the reason I think it's so successful is that it essentially, it's something that takes a while. So it's like an overall shift in the market, if you will. This could be called a cup with handle, but it could also be called a double bottom. You can see clearly we got our move there as well. Let's see, crypto here. Let's take a look at Cardano. So this would have been a cup with handle. Generally, you want to see wider patterns if you can get them. Here's a nice wide pattern with a little bit of a handle, and we took off from there. So you can see that they do exist. They do happen. They are a fairly reliable signal on higher time frames. Shorter time frames are a little trickier, but you trade them the same way. There is such thing as an inverse cup with handle, which is basically this, but they are not reliable, not anywhere near as reliable as the standard cup with handle. And you also have to keep in mind, if most people are not looking for them, it doesn't have that kind of follow through effect. So in the next video, I'll add some, the usual indicators, support and resistance, that type of thing, and show you how you would have traded this in the real world. Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, we'll take a look at some examples with the cup and handle pattern. So this is Cardano, the ADA Tether US market. You can see that we had formed, this is kind of a multi-pattern situation because you could say double bottom, which obviously is a potentially bullish sign, or you can look at this and you'll find this time and time again where you actually have a couple of patterns and there's your cup and handle. Either way, it's bullish, and it's bullish for two different reasons, and we like that. That's really, the more people out there looking at it as a potential bullish move, the better off you're going to be. You can see that this was your handle. We broke out, we kind of hang out here, and then we take off. So a quick scalp, you're basically just aiming for this move. Now, at this particular juncture, Cardano wasn't exactly flying, but you did get the 1 cent move you were looking for. Yeah, it took a little while, but you got there. So, pretty straightforward trade at that point. Let's go ahead and take a look at a stock. Let's do AT&T. So we're on the 5-minute chart in AT&T, and you could make an argument for a very messy cup with handle there. You would have actually gotten stopped out, but that would have perhaps qualified as it. It was a little messy. If your stop was here behind the handle. Now, if you took the really conservative route, you may not have gotten hit. So this is another cup and handle. You can see right there. We took off to the upside. We certainly got our target. Let me go ahead and show you. Target would have been about there. Well, we took it right about there. And we got it. It's also, bottom of it's right here at this previous resistance barrier. Now support, as you would expect. Let's go ahead and add the moving average. There's the 9. Let's add another moving average. Let's make this the 20. And you can see we got the cross right there in the middle of it, and then we really spread out nicely on a break higher. So yet another reason to think that perhaps we were going to continue. Plus, I mean, when you look at it, it's the overall trend, and that's really, at the end of the day, the most important thing. A little bit of a volume spike right there as well, so it all ties together quite nicely. And finally, let's take a look at a Forex. Let's do Thai or excuse me, not that. We want Turkey yen, or Turkish lira yen, I should say. You can see a little bit of a cup with handle right here. 842 offering support and resistance. So 8.42, and you can see there's the pattern there. Let's take a look at MACD. We are crossing right here as we get into the handle, so that was a sign that perhaps we were starting to pick up a little bit of strength. Back to our moving averages. You can see that the 9 is showing life, just as the 20 will be doing the same. And we crossed right there, and then as we got through the handle part of the cup, we really took off, and we clearly hit our target there as well. Pretty straightforward pattern. Does tend to, and I will say, it's not that you can't scalp with it. It's not that you can't use short-term charts with it. It does carry more weight on the daily, especially one that lasts for months. That's more of a traditional stock trading type of situation, but it is where you see it used the most. So in the next video, I'll take a look at wedges and triangles.
Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, we'll take a look at wedges and triangles. So a wedge is when price moves like this. In this case, this is a bearish wedge, or like this, which would be a bullish wedge. The idea is that you are moving in one direction or the other. So in this case, you're in an uptrend. In this case, you're in a downtrend. And you'll notice that we're squeezing. So the idea is if you can break the support here at this trend line, you could go down to the bottom of the wedge. Just like if you can break the resistance here at this trend line, you can go to the top of the wedge. They're pretty common patterns. A lot of people like them. They are consolidation, but it's consolidation within a trend. Triangles, on the other hand, look like this. This is a symmetrical triangle. You'll notice that this is back and forth and we're getting tighter and tighter. The thing about a triangle is you want to see it break out in the first 80% of the shape. So you don't want to reach the apex. You want to break out one direction or the other. So this symmetrical triangle shows that the market is tightening up, and it shows that we're probably going to make a move rather soon. Typically what happens is you either break higher or lower, and whoever's on the other side has to cover. So in a symmetrical triangle, and it's a 50-50 shot in a symmetrical triangle, you put your stop loss underneath the apex, and if you break higher, you go long. If you break lower, then you put your stop above the apex and you go short. The body has a measured move built in. So let's just say this here is $5. Well, the idea is that you go $5 in one direction or the other, and that is a symmetrical triangle. There is also a descending triangle and an ascending triangle. They both have the 80% rule, but you also need to keep in mind that a descending triangle shows that the sellers are starting to really pressure the market. So you're expecting a breakout to the downside once you break through support. An ascending triangle, the exact opposite. You break through resistance and you go higher. The measured move over here, let's just say it's $5 again. Well, you're expecting to move $5 lower or $5 higher. So let's take a look at some of these patterns. Notice here on Microsoft on the 5-minute chart, you had a bit of a triangle here. We broke through it, kind of hung out, and then broke back down. Let's see, where else? We have an ascending, potential ascending triangle, and actually it did work. Now that I look at it a little closer, and I am zoomed out just to show you how this plays out on longer term chart. There's your measured move. There's your move. You're good to go. That's ascending, so you were expecting it to break to the upside. Notice this descending triangle. We broke down and definitely hit the target. That's the thing. A lot of times you actually overshoot the target, but that's the only thing that, as far as trading is concerned, is, I don't want to say guaranteed, but projected is probably a better word of which direction we're going. Wedge here. Not only did we break down to the bottom, but we gapped down there the very next day immediately. There was no hesitation. So that bearish wedge kicks off. So let's go ahead and take a look at, let's go to the world of Forex. Find something with a little bit of volatility. Aussie yen. So Aussie yen, you can see triangle here, poorly drawn by your instructor. There you go. You can see we broke down. We came back and retested this. That's not that rare, really, because it's a support level, and then we shot lower. That was your projected target. You clearly got quite a bit more than that.
So notice this. You could have said, okay, well, we're setting up this wedge here. So we're going to break down lower, but you did not break the trend line. So it is a failed pattern, meaning you shouldn't have even been involved. So be aware of that. You don't. One of the biggest mistakes you can make actually is anticipating a move, because it needs to be confirmed. In this case, you need to break a trend line. Here's a bullish wedge. Poorly drawn again. There you go. Bullish wedge. We break higher. Your target was here. Clearly didn't have any issues getting there. And let's take a look at the crypto world. Solana. So here's a descending triangle. Bearish look. We broke down quite significantly. Not a huge surprise. Here is a rising wedge or a bearish wedge. What I like about this is that it is a continuation of the overall pattern, and we just fell apart at that point. So you can see these patterns, they're nice because they show you where the buyers and the sellers are trying to kind of pick up the market. So I like that. It comes with a measured move, kind of a measuring stick built in as well. So that's a big advantage to these patterns as well. So in the next video, I'll take a little deeper dive into some of these patterns and add some indicators and show you how it works in the real world. Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, I'm going to run through some examples of scalping with wedges and triangles. So let's go ahead and turn the volume back on here in Solana. Notice this descending triangle, and if you remember from the last video, it was one of the ones I showed you at the very end of it. Notice how it's got a nice run here. And just right before we get the apex, we break down it. And that's pretty common, actually. You can see that we broke down. Measured move, quite easy to make. Take the line tool here and measure it. So that would be your projected target right where there had been previous resistance. So you would expect a little support. Let's go ahead and take a look at the moving averages. Notice the 9 really starts to fall off of a cliff there. Let's put the other one on, and since it's short term, we'll do 9 and 20. Nice spread right there. So it really breaks down quite nicely. And shows that we are ready to go much lower. So let's go ahead and get rid of these two. As I look at the chart, you can see this is kind of an interesting one here. So take a look at this. This is a little bit of a wedge. We did have a false breakout. So what that means is that the market tried to take out this resistance line and failed. So that's something you should pay attention to. Target bottom of the wedge, that's where we hit. Plus, we had a crossover right after it. So that could be reason enough for people to get interested in shorting the market. So here is a triangle within a consolidation pattern. So you can see how we've been consolidating here, but then started to see a little bit more pressure to the upside. And we broke out ever so slightly, pulled back, and then found the moving averages to offer support and hit the target pretty quickly. So let's go ahead and remove that. Let's go over to stock and the stock market. Let's go to Tesla. Tesla, trading this on the 5-minute chart is a wild one to say the least at times. You can see how quickly this thing moves. $50 in a half an hour. So as you take a look at this market, you can see this one would have been difficult. You could have said, all right, fine, that's an ascending triangle, but it gapped higher the next day. You really can't do a lot with that. So here is a rising wedge, which remember is bearish. We get a nice crossover right after that, and we take our profit. At the bottom of it, we overshoot and come down to support. Not a huge surprise. That tends to be how these markets play out. And in fact, let's take a look at, see, right here, we had the RSI rising right along with the market and then started to fall. So you already had divergence kind of coming along at that point as well. There it is right there. So we have another triangle. We get the crossover right here. We hit our target pretty quickly. And on the MACD, we had the cross right at the bottom of it. We crossed the 0 line as we rallied out of it and triggered the buy order. Let's take a look at some currency trades. Dollar Canadian dollar, kind of a noisy pair, but it does move occasionally with some real gusto. This is driven by oil, so keep that in mind. Now you can see this triangle here was actually broken out of long before the 80%, and that's good because that means you're going to probably have a bigger target because it's wider and, of course, more momentum. You can see we did hit that pretty quickly. Again, crossover right in the middle of it, not a huge surprise at that point. You could also make an argument that there was a bit of resistance there that we were kind of chopping around and finally broke down. This is an interesting little wedge here. This is a bullish wedge. And you can see once we broke that line, I mean, we hit it. Let me go ahead and get rid of this. We hit this almost immediately. Like once you broke out there, you were long, you were ready to go, and you took profit in a couple of minutes. So like those types of trades, definitely. So as you can see, this works with, a lot of the stuff that we've been learning. Wedges and triangles, a lot of people recognize them. It's kind of self-fulfilling prophecy, and we like that. So in the next video, we're going to take a look at another very widely followed pattern or patterns, bullish flags, bearish flags, bullish pennants, and bearish pennants. So the flag and pennant patterns.
Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, we're talking about flags and pennants. So a flag or a pennant, they're both essentially the same thing. It is a long run in one direction or the other, bullish or bearish. And then the difference between the flag or the pennant comes down to the consolidation. So a flag would have, like a little channel. You can see it's a pole and it's a flag. Now, a pennant, it's more like a triangle. You can see it's a pennant. So they come in both flavors. There is such thing as a bearish flag, and there is such thing as a bullish pennant. These are great patterns because everybody recognizes them. I would also point out that they're great because you can measure the pole of the flag, and once you break out, that's how far you're supposed to go. So if this bid here, let's just say it's, I don't know, $5. A breakout above there means $5 is what you're aiming for. This, if it's $5, a breakdown below there opens up the possibility of $5. You put your stop loss on the other side of the flag or the pennant, and you're ready to go. So let's take a look at a couple of examples. Nice run higher here in Bitcoin. Nice flag. We take off. You can see, I mean, there's no doubt whatsoever that we hit the target on Bitcoin. So it happens in all markets as well. You can make an argument for a bearish flag here in AMD. Stop loss above the top of the flag. You're expected to see this, or you're expecting, I should say, to see this market go lower. And it does, in fact, do so. You can also make an argument for a bearish pennant. Not for a big move, but it did, in fact, happen. So, they can't all be home runs, as it were. And you can see that time and time again this happens. It's kind of like the triangles and the wedges situation where they're common enough that you get enough people joining you, you typically do quite well. So, like, here's an ugly one here. Look at this. I mean, this is a really ugly flag. But does it work? Well, let's find out if we break out of this range and we get the move. Notice that we broke out, we pulled back to find support at this previous resistance. Let's see. And this, pull it back here to the pull. Yeah, that's pretty much exactly where you ended up. So you have to keep that in mind. These are great little patterns. The higher the time frame, the more important they are, obviously. Like a flag on a weekly chart is going to matter a lot more than 5 minutes, but obviously you won't be scalping off the weekly chart. So in the next video, I'm going to take a look at some examples and show you how to use this with some things that we've learned already. Hello and welcome back to the complete scalp trading course by Wealthy Education. In this video, we're going to take a look at using these flags and pennants in the wild, as it were. So let me go ahead and mark out this flag here. You can see we've kind of had, and really, it comes down to how you draw it. It really doesn't matter. You can make it a pennant if you want, or you can make it a flag, because you can also say that, well, there's a little bit of support there. At the end of the day, what does it matter, right? So your target is down there. That ties together quite nicely right here at previous resistance. So it all kind of works out, and that happens quite a bit. Let's take a look at your moving averages. This is a 15-minute Ethereum chart. You can see that the 9 just broke apart at that point. Let's take a look at MACD. We got across all the way up here and had divergence this entire time. So you should have been looking for some type of opportunity at that point. Here's an example that I like because, new traders get sucked into this. Look at this beautiful bearish flag. Well, the bearish flag never triggered. So you would have certainly had some issues. Bullish flag triggered to the upside, though. Lots of resistance right here. So let's take a look at our setup and see if we got to where we needed to go. Okay, so at this point we broke out, and man, we just hit it like right to the tick. Pretty amazing. The 9 broke out of there. Looks pretty good. There's a little bit of previous resistance there, so it might be time to get out. Shooting star and a hanging man both telling you, I mean, you could be a seller at this point if you chose to be. But in this scenario, I would use this more or less as a sign to get out. So over here in Neo, you can see that we have had a pretty big move on the 5-minute chart. Take a look at this area as a flag. And you can see, I mean, it took forever and a day, but we got there. For that matter, I see another one. So take a look at this little miniature flag. That happens a lot too, where you get a couple of them. And you can see that we clearly hit it. So $25 offering support. Let's go ahead and see if the Bollinger Bands told us anything. Yeah, we pulled back to the median and then rallied right up here to break above the Bollinger Band. So that looks pretty good as well. Let's go ahead and get rid of all of that. here is a situation where we continue to see a little bit of consolidation and continuation of the overall downtrend. I see no reason to fight it. What's interesting here, take a look at this. It stops right there at that gap. Well, once we break through it, we're off to the races. So keep in mind, right down here to support. Really good looking setup there. So as you can see, here's an example before I let you go. Here's an example of one that didn't work. Check it out. Nice, beautiful, bullish pennant. Never kicked off. So you have to keep that in mind as well. Again, you do not want to look at that and go, hey, I have to get long. Let it break out. You have plenty of time. And with that, it is the end of Module 4, Scalping with Chart Patterns, and the end of the course. Just a quick note to thank you for taking the complete scalp trading course by Wealthy Education. I hope you enjoyed this course, and I hope you refer to it time and time again as you start your scalp trading career. Again, thank you so much for watching.